Report. The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Apollo has been looking at West Palm. They have been looking at outside of New York for offices. How are you thinking about your footprint as people return to the office and want to work from different places?
Yeah, so it's the new Apollo. I think flexibility is the name of the game. When it comes for us in our business, I think that we really preach the mantra of flexibility. I think we've proven throughout COVID that we could be highly effective. In fact, if you look at the bottom line, I think more effective than we've ever been in our history through a flexible work environment. So as we head back for the fall, we've really preached to all of our businesses to lean in and embrace this flexibility and go where the market goes. We're in a competitive industry. Our portfolio companies are in a very competitive labor environment. And I think businesses that just want to go back to the way things were are missing a huge opportunity to learn from what's gone on over the last 18 months.
Had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The time to lay out a plan for COVID-19 boosters is now. Recent data makes clear that protection against mild and moderate disease has decreased over time. This is likely due to both waning immunity and the strength of the widespread Delta variant.
That was Dr. Vivek Murthy, the U.S. Surgeon General from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market this Thursday morning shaping up as follows. We're negative. We're down 33 on the S&P. We're negative 0.8%. It's a classic risk-off setup here with a bond market bid, a dollar stronger, and a commodity complex that's a whole lot softer. Yields are lower by 3 or 4 basis points on 10s to 122.33. Euro dollar back with a 116 handle. Negative there by a little more than a tenth of 1% at 116.93, Tom. And in the commodity market, just about holding on to 63 here on WTI. We're down by 3.73% to $63 and about 2 cents.
On radio and television this morning, we'll do more data checks, keep you abreast. The VIX 17, 18 out to 23.81. That does get my attention. 30 is sweat. We're not there to sweat, but nevertheless well on our way. 23.81 on the VIX. This is an important conversation because Jennifer Nuzzo reads the research. Jennifer Nuzzo, the New York Times has a standout article on these silly plastic barriers that have invaded our lives. That includes Johns Hopkins University research, which say desk screens could actually give us an increased risk versus intelligent use of masks. Can you help us with the plastic that's engulfed us? I am hermetically sealed from Lisa and John. I haven't hugged Lisa in like 18 months.
That's not because of COVID.
I mean, help me, Jennifer.
I think Lisa needs help right now, Tom. Can you ask the doctor a better question?
I miss you guys so much. Jennifer, please, on the plastic screen, help.
Some
somebody reach over and hug Tom. He really needs it.
Go ahead.
No, I mean, listen, we don't have a lot of evidence for a lot of these things. I think intuitively there are probably some environments in which it makes sense. If, for instance, toll booth operators, people who have a lot of exposure with the public, putting another barrier between those people and the people they're serving, I think makes a lot of sense. But when you see people sitting at a desk and they have like a 3-foot, plexiglass between them, it's not clear what that does, if anything, and it sounds like it could potentially cause harm. The bottom line is probably not going to be as protective as a mask, although, we always try to layer these interventions. But, I think the most egregious example of the plastic was at one of the vice presidential debate, those tiny little things that separated the vice presidential candidates. Not going to do much.
Help me with then the need to get vaccinated. What does the last 48 hours show you within all your reading and research about the getting vaccinated?
That has not changed. If we do anything to put ourselves back to normal, to go back to our lives, it is to get vaccinated. There is nothing new in the data that suggests otherwise. Heard a lot of news yesterday about the potential need for a third dose. I will tell you, most people, including myself, think that the data aren't quite there to suggest that most people need it. There are clearly some small groups of people that absolutely need extra help, and that's the immunocompromised, and they're already able to access a third dose. But as far as people broadly, we're not yet convinced that that's happened. The bottom line is the vaccines are still doing exactly what they need them to do. They prevent us from getting ill enough to get in the hospital, which again, if this virus couldn't do it, we'd never hear of it.
Dr. Nuzzo, then when do we stop caring whether we get infected? Because right now, I'll tell you, I'll be honest, as a vaccinated individual who has a child at home, and I sound like a broken record, who is not vaccinated, I care as much about getting infected as I do about getting very sick, just simply because this will affect the people who I care about. So when does that change?
Sure. So I think that's exactly a potential off-ramp for caring about getting infected. I have also unvaccinated kids at home because they're too young. And hopefully when vaccines become available for them, that'll lessen those worries. But getting a third dose doesn't necessarily prevent you from getting infected in the first place. So that's unfortunately not going to ease those worries for you.
Dr. Nuzzo, there have been reports about new antibody therapies coming out of China that have actually been somewhat promising. How much does that potentially provide a game changer here where we can actually combat this and treat it more like a regular illness?
I think that's, one of the missing areas that we need more progress on is treatments because, there will be still some breakthrough infections, but also we know we have a lot of people who are not vaccinated and are going to need treatment. So that is, I think, an important area of research. We have some things now, but they're not very scalable. You still have the monoclonal antibodies you hear about. You have to go to a center and basically be hooked up to an IV. And so it's very hard to deliver that at scale, particularly given the number of cases that we have. If we could give somebody a pill and treat them, potentially even at home like we do for influenza, I think that would have an enormous contribution to lessening our worries about this virus.
Jennifer, New York City restaurants, and I'm sure other restaurants that our listeners and viewers are familiar with, they're in an uproar about paper vaccine inspection to get into their restaurant. When do we get away from the silliness of the 1850s? When do we get away from a paper document that's clearly instantly forgeable?
Yeah, well, I mean, I think that's a real problem. People can forge it. Unfortunately, the apps are not potentially better than that. I think there was a story about one of the apps being used in New York where you could just upload any photo and get a green check, and then it's on the bouncer at a club to scrutinize whether you got your 2 Pfizer doses on time. I think there are people who are pushing for a more verified vaccine record. Of course, that raises all sorts of concerns and potentially concerns among the people who have not yet gotten vaccinated. And we absolutely don't want to turn those folks off. But I think, we're seeing right now the challenges of the immunization records that we have. They're easily forgeable. In my view, people who are determined to not comply will find a way not to. People are very crafty. And so I tend to focus on changing hearts and minds and make sure we convince people to get vaccinated.
Doctor, thank you. Appreciate your time and perspective as always. Dr. Jennifer Nuzzo of the Johns Hopkins Center for Health Security. Tom, I think we also need to talk to mental health experts as well about the damage that's being done to society more broadly. And Lisa mentioned the children. Indulge me for a moment and allow me to talk about dear baby Charlie, my nephew, my godson. He went to the park the other day. He's 2 years old. He's 2 years old in just a couple of weeks. He went to the park, said hi to another 2-year-old child, touched the child on the arm, and the other kid ran away to his mum because baby Charlie had touched him on the arm because he'd been told at nursery that you can't hug each other, you can't hold hands, and you can't touch each other's arms. Tom, that's what we're doing to children around the world.
We're all dealing with it daily. I mean, we hear it, folks. Of course, we're talking to our guests all the time, off the mic, off the camera. We got a huge network of people here from all walks of life. And John, I'm hearing it 24/7 from everybody. And guess what, John? It's honest. I had to buy school clothes yesterday, uniforms and all that stuff. We're there. School, even for people starting in September.
I think the point I'm trying to make is that we're often having a very narrow conversation about the pandemic.
True. Yes.
And we're not having a broader conversation about a broader health crisis that's taking place.
Lisa's living it every day.
And the consequences of which, Lisa, we'll be living with for a long, long time.
Yeah. No, honestly, this is something a lot of people are going to be studying. If either of you do need a hug, it's fine.
You give
I'm
that a hug.
vaccinated.
We're medically sealed.
I don't know what's going on.
Yeah.
Did you fall out?
I'm just trying to get everybody back on one desk.
Okay. From New York.
That's how?
This is Bloomberg.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When the economy's in trouble, you use your fiscal cannon to deal with that challenge. We're now in an ambiguous moment.
The markets are kind of hinting that the Fed may be making a mistake by moving too early on the taper.
The biggest driver, I think, of growth slowing is the fear of restrictions from the Delta variant.
When it is your hard-earned money as opposed to tax dollars, it takes a bigger hit to that mental outlook.
There's a ton of cash on consumers' balance sheets and corporate balance sheets. That eventually needs to go somewhere.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
If in doubt, blame the Fed. From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down 32 on the S&P. We're negative 0.75%. Tom Keene, if in doubt, blame the Fed. And once again this morning, that's what many people are doing.
Well, the Fed's always in the crosshairs, but it's much more than that. And I'm going to go to the beginning of the Goldman Sachs markdown yesterday. The first sentence, they mentioned Delta variant. This isn't about economics, John. It's about the fourth story of this pandemic.
I couldn't agree more, Tom. The title of Goldman's downgrade was not related to Fed tapering. It was not related to an increase of interest rates on the horizon. It was a larger Delta variant impact on GDP and inflation. They downgrade Q3, but they upgrade Q4. And I think that's the bet, Tom, that we need to discuss. Is it something you lean into? Is this weakness something you buy?
Well, we heard that from Andrew Slemman. We've got a lot of other people coming up as well on that. Ben Laidler, hugely bullish. Even Doug Cass nibbles today within the drawdown that we've seen. John, what I wonder is at Jackson Hole, should they rip up the script? And on the lawn with those lovely white tents for the Saturday lunch, should the head of the CDC speak to the economists?
I imagine they're going to be talking about that themselves, aren't they, Tom? Because as Tom mentions, this is as much about the pandemic as it is about anything else. And it's as much about China as it is about the Federal Reserve.
Which raises a question about that fourth quarter projection from Goldman Sachs, which is basically this idea that we can get production back online by the fourth quarter. Can we? I mean, how do we have that certainty? Can we hire enough workers to do that? What's the situation over in China? And what's the tolerance level for each case of COVID that gets diagnosed?
The ultimate bias, though, Lisa, and I don't think this has changed, is that it's recovery delayed and not recovery derailed. And that's been the bias now, Tom, since last summer. We've been talking about Q3 2020, Q4 2020, then it was 21, and now it's the back half of 21, and now we're talking increasingly about early 22. It's recovery delayed and not derailed, and that's still the bias right now.
And within the shock of Afghanistan and the other set of shocks we have, John, it's August where we recalibrate, not so much, folks, for Q3, Q4. And, John, I'm going to go back to the Goldman note because everyone's doing this, including Jan Hatzius. They're trying to guesstimate their 2022, and boy, is it a mixed set of opinions.
Yep, and futures right now, Tom, we're negative. We're down 0.7% on the S&P. Let's whip through the price action for you. Get you all up to speed. Yields are in 3 basis points to 122.50. It's that classic risk-off setup, the risk aversion bleeding through the commodity market. 62.97. It's a break of 63 on WTI. We're down for a 6th straight session and negative 3.8%. And Lisa, euro dollar with a 116 handle. We're negative there, a little more than 0.1%. 116.94.
Yeah, that dollar strength really bleeding through all of the G10 complex. I was struck by what you said, John, this idea of recovery delayed, not derailed. When do we change that idea? When does the delay have ramifications that last much longer? 8:30 a.m., we get U.S. initial jobless claims and continuing claims. Do we start to see an unexpected increase in firings as a result of some of the shutdowns and as a result of some of the supply chain disruptions? And I wonder about that in light of exactly what you said. Services account for a significant portion of this economy. They still have not fully recovered. 9:45 a.m., we get U.S. Langer consumer comfort for the month of August. How much are we seeing consumer comfort affected by the increase in Delta variants? And then at 10 a.m., we also get the U.S. July leading index, which will give some sense of this. But John, I really do feel like that is a question. How long can a delay occur in the recovery before it has a longer lasting scar? And frankly, I have not seen any kind of projection that gives any kind of clarity to that.
Well, let's get straight to it, Lisa. Thank you. Stuart Kaiser joins us now, UBS Securities Equity Derivatives Research Head. Stuart, let's start there. Is it really recovery delayed and not recovery derailed?
I mean, I think we better hope so, Jonathan. That's certainly how the market's priced. Even though we're off 3 days in a row here, we're still kind of near all-time highs. I would say our consumer survey work, which we do on a weekly basis, I think points to that in the sense that those consumers still think the employment outlook is very strong, but their views on returning to work have declined substantially. So I think the consumer is still seeing a strong economy. They just are a little bit less excited to participate in it, because of the Delta variant and other things. And I guess the question there is one of persistence. How long will it take them, to be convinced to get back fully engaged? And to your point, that's the ultimate arbiter of how the economy looks, call it, 2 to 4 quarters from now.
Stuart, what do the derivatives say, and particularly what do they say about catharsis? We've had a drawdown of 2%, let's say. We're nowhere near a correction. I'm going to suggest there's no true catharsis out there. What does the math say about it right now?
Yeah, I think the equity derivative setup has been pretty similar for the last few months, which is, 3 to 6 months out, there's a lot of risk priced in, both in the level of volatility and the cost to protect your portfolio. That's been the case, and we expect that to be the case. If you look at the shorter dated stuff, a similar story. Vols have come up, but if you look at how low realized volatility has been for the last couple of weeks, the level of the VIX, for instance, would not be justified by the level of realized vol. So, the market is a little bit on edge, but I would say we're not kind of at that, kind of run for the hills mentality quite yet.
When it comes to the bullish sentiment, how overly confident are people, though? I mean, I hear that people are trying to buy some protection in order to hedge the downside surprise. But do you get the sense that there is an increasingly bullish feeling that no matter what happens, people are going to come in and buy the dip?
Yeah, I mean, I think we are still in the buy the dip mentality, I would say, at the index level. It's below the index level where things have been a little more wonky, in terms of, am I willing to buy that reopening trade? Am I willing to buy the casinos and the airlines and small cap stocks and things of that nature? So, S&P sends you one message, and the below the surface stuff, can send you a slightly different message. I think by and large, people still do believe in the reopening, and they, I think, are of the view that the Delta variant is going to be, this too shall pass, type situation. But, 3 days down in a row for the index will definitely get people's attention. But, my view is, yeah, we're probably still, most clients we speak to, I think, are still generally in the buy the dip mentality and are probably looking for opportunities to re-engage with those reopening trades when they get to a level they're comfortable with.
Stu, just getting some headlines from the President of the United States. Let me jump in and just read out a few of them. This was in an interview with ABC. Some of the headlines as follows. The president saying no one anticipated Afghan troops would give up. There was no consensus in the intelligence. Advisors were divided on the withdrawal from the country, from Afghanistan. No one warned him to keep 2,500 troops in Afghanistan. Would have withdrawn troops even without the former president's deal, President Trump's deal, Tom. The president going on to say there would have been no good time to leave. Just some additional headlines from the president of the United States there in that interview conducted with the American broadcaster ABC.
The best summary, folks, to bring you up to those headlines is James Stavridis in Time Magazine, the former NATO commander. He will speak to Surveillance today. John, there's going to be all sorts of opinions and second guessing on this. What is the president going to do forward for Afghanistan, for the migrants out of Afghanistan, and to support the world in this debacle? That's the real question.
We'll get the forward look, Tom, down in Washington in about 10 minutes' time. Stu, I want to come to you on the market question. Tom, myself, Lisa, we've been having this conversation now for the last several days through much of this week. Does the international problem overwhelm the domestic policy goals? Infrastructure is a conversation we've hardly had this week. Do you have a take on that, a position on that at the moment, Stu?
I mean, I think the international growth risks are pretty evident in the rates market, over the last couple of months, right? Which is, Delta, I think, is viewed as more of a global risk to growth than a U.S. growth risk at this point. And I think that's forced central banks and governments globally to behave, quote unquote, a little more dovishly. And I think that's one of the contributors to getting U.S. real and nominal yields down to the levels they are. Is that enough to kind of overwhelm the domestic stimulus for U.S. markets? I would say not yet, but eventually that balance will shift if this is much more persistent. But I think we are definitely seeing global growth risk kind of spill over into the U.S., particularly through the rates market, but I think you're seeing it below the surface a little bit in equities as well.
And a lot of that's coming out of China at the moment, that's for sure. Stuart, thank you, sir. It's good to catch up. Stuart Kaiser of UBS. Lisa, let's run through those headlines together. The President of the United States, in an interview with ABC, saying the following: there was no consensus in the intelligence. The intel community did not predict a quick Taliban takeover. There would have been no good time to leave. He said no one warned him to keep 2,500 troops in Afghanistan. Just responded to some of those questions about what exactly the intelligence told this White House, this administration.
You know, Tom mentioned Admiral Stavridis, and he wrote a column in Bloomberg Opinion where he was talking about how the Afghanistani army was not equipped to fight the Taliban. And even though the U.S. set it up with all of these, high-quality equipment portals and all of these types of, U.S.-style army paraphernalia, that was not what they needed. They needed more guerrilla warfare. They needed more kind of local organization. And as a result, that anyone could have seen this coming, which was interesting given his role in the administration back in the old days.
So many of the questions that have been asked over the past week, and we've all been asking it on this question, is about how this White House, how this country left Afghanistan. This is the president's position on that, Tom. He does not think the withdrawal could have been handled better. That's the position of the President of the United States on the how question. He doesn't think it could have been handled better.
Okay, I'll go with that, John. And there's going to be a lot of navel gazing over the navel gazing. John is an American phrase.
I'm aware of it, Tom.
Idiomatic phrase.
I'm aware.
Maybe lost in translation.
We do it sometimes.
Yes, but John, what I find so important here is they invented a liberal democracy in Afghanistan, and now I guess they're going to export that liberal democracy out of Afghanistan. That's what we got to focus on right now.
So you mentioned the forward look, Tom. The president going on to say the United States will do all in its power to get Americans and allies out. And that's very much the forward look now, isn't it?
That's the forward look.
Next steps.
And, based on what I've seen in the zeitgeist, the French are leading the way with the French embassy still active in Kabul. Again, that's from secondary sources.
We'll get the view down in Washington. Up next on this program from New York City this morning. Good morning. Alongside Tom Keene, Elisa Abramowitz, I'm Jonathan Ferro. The President of the United States to ABC. The United States will do all in its power to get Americans and allies out. From New York City, this is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden will keep U.S. troops in Afghanistan until all Americans are able to leave the country. That's even if it takes longer than his August 31st deadline to withdraw. The president also told ABC News that U.S. intelligence didn't foresee such a rapid advance by the Taliban and collapse of the Afghan military. A new study says that coronavirus vaccines are less effective against the Delta variant of the disease. That could lead to a push for booster shots for fully vaccinated people. The British study said that Pfizer and BioNTech's vaccine lost effectiveness in the first 90 days after full vaccination. In China, regulators have issued the harshest warning to the struggling Evergrande conglomerate. They demanded the company resolve its debt risks to ensure the health of property and financial markets. Evergrande has more than $300 billion in liabilities. Its fate has broader implications for the financial system and millions of homeowners. Goldman Sachs is expanding its presence in Europe. The firm has agreed to buy the asset management arm of Dutch insurer NN Group for about $1.9 billion. About three-quarters of the business's $355 billion in assets are backed by environmental, social, and governance criteria. Macy's is out with a sales forecast for the fiscal year that beats estimates. The department store chain also reinstated its quarterly dividend and authorized a $500 million stock buyback. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We talk about those NPLs. Will they stay high?
As all of you are very fully aware that the second COVID wave hit India hard and hit India suddenly. So obviously, I would say almost 50 days of the quarter were impacted in a very significant manner. And that has come through on the retail portfolio side. So while all the banks and financial institutions saw higher than expected retail slippages during the quarter, but we do believe it is transitory. We expect moderation in the second half of the year. We've already seen positive trends come through in the second half of June, and July has been much better than June. And I think the same trend has continued in August also. The demand resolution, which was 98%, is already reached 99.5%, or what I would say pre-COVID levels. There is a 26% year-on-year recovery, improvement in recovery.
This is Venezuela, a country that has suffered one of the greatest economic and humanitarian crises in modern history. Today, it appears Nicolás Maduro and his government are prepared to negotiate an agreement that might end U.S. sanctions and pave the way for free and fair elections.
Hopefully we can find paths of closeness, of respect.
Join Bloomberg Television for a special report, Inside Venezuela, Friday at 7.
A little bit of a sell-off to get your teeth into from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here is the move lower on the S&P. Another day of it. We're negative 0.8% on the S&P. On the Nasdaq, down by about 0.7%. Into the bond market, firmer. Yields lower. We're down 3 basis points. Treasuries 122.67 on 10s, Tom. 63 handle on WTI. Just $63 and negative 3.76%. Commodities, Tom, a bit of an issue this morning, and there's a lot going on. It is not just the Federal Reserve. It's China, it's Delta, take your pick. I think you used the words yesterday, it's the cross currents just coming together. And Tom, I think that's a decent description of where we're at.
Correlate now to a strong dollar, 93.35 on DXY. For those in the know, that's a big move. John, my pro tip is when it's like this, everybody's got emotion, everybody's doing this, that, and the other thing. You know what? Watch the VIX, just reprinting, I should say, 24.03, high 24.75. John, everybody's got an opinion of where the VIX sweats. 30 is my number.
Well, here's my view. I think that Chairman Powell's speech next week gets a little bit more interesting, Tom. And I imagine if he could schedule the date himself and reschedule Jackson Hole, it might be on September 4th, after the jobs report on September 3rd. That might make a little bit more sense at this point.
Well, maybe, but I'm guessing he's saying everybody calm down and let's start rewriting the Jackson Hole speech.
Oh, you think a rewrite?
Say on Tuesday. Oh, yeah, it's going to be a rewrite.
I think some people have jokingly said we've had about 10 of those, Tom, over the last month.
No, I think they're going to go into major triage here to say the right thing out in Wyoming.
Lisa disagrees.
Well, I think that their goal is going to avoid saying anything. They're going to be talking about income inequality and things that are not necessarily going to play into their strategy because they just don't know right now.
You think a nothing speech next week?
I think that's the goal.
Can you get a refund on your flights?
Why are we going? I was going to say.
It will be beautiful.
Oh wow! That was your pitch. That was your pitch to management.
No, look, I think it could be. Look, I think it could be interesting, and let's get to our guests. But I will
Lisa
say,
wants to run now.
My point is they don't want to say anything that they might have to reverse in just a couple of weeks when we get more data in such a quickly moving situation.
I love that pitch.
Second pro tip of the block is Jack Fitzpatrick knows at the Pioneer Grill at Jackson Hole. The big decision is do you have the hangover breakfast or the cowboy grill breakfast? I mean, that's the way it goes. Right now, Jack Fitzpatrick on the serious nature of Washington on a very serious Thursday. Jack, just simply, What is the president's to-do list today? Not so much the agenda, but what's he saying we got to get done today?
Today and in the very near future, they're still in the process of adding that 6,000 increase of troops back into Afghanistan to try to essentially work with the Taliban to continue getting Americans and other Afghans at risk out of the country. It is notable that yesterday, Mark Milley, the chairman of the Joint Chiefs of Staff, said that this isn't something the U.S. can do, just essentially gaining ground in Afghanistan. They're reliant on the Taliban's cooperation there.
Herat is 500 miles west of Kabul. Okay, great. How do we get X number of Americans in Herat to Kabul to get out?
With the cooperation of the Taliban and assuring them, apparently, that even though the U.S. is saying troops could stay past August 31st, we're more or less still abiding by the agreements that were set in place a while back and in the process of leaving and taking a very limited steps toward getting Americans and a limited number of other people out. It's difficult. It's something the U.S. military can't do single-handedly. It's more, according to Mark Milley, a sort of a political operation and a political negotiation with the Taliban. And it's sort of a shaky situation because of that. It's not something the U.S. military can go enforce on their own terms at this point.
Jack, I want to clarify a point. When President Biden comes out and says that it couldn't have been handled better, I do wonder about the processing, the paperwork for some of the workers on the ground in Afghanistan. They were working for months on trying to get people here, and they said that some of the paperwork got backed up. Can you give us a sense of what happened and how they're going to expedite that in order to bring more people over in a more expedited fashion?
Yeah, that comment almost seems a bit self-contradictory when you look at the fact that the president also said they didn't really have intelligence indicating this is how everything would go in Afghanistan and that even Kabul would be taken over by the Taliban so quickly. The process on some of these special immigrant visas was started ahead of time. There was some preparation. They even worked with Congress to get about $1 billion to expedite that ahead of time. But the conversation around that was not in the context of everything's going to fall apart immediately in the month of August. So there's clearly work still left to be done after the point at which the U.S. was supposed to be really in the process of drawing out of Afghanistan. Right. So it does not appear to really be true that this is the inevitable way that it was going to go. There were some steps taken ahead of time on visas to get people out, but the context of those conversations and what they did ahead of time was not on the same timeline.
Yeah. Well, Jack, this is important, especially as we talk about the broader labor economy, this idea that there seems to be a shortage of workers in a number of different areas, spotlighting the immigration issue. Are you seeing the Biden administration take a more open approach to immigration despite the COVID pandemic that's ongoing in order to stave that off and in order to provide a humanitarian need to places like Afghanistan?
Politically, I think you can see why the Biden administration may have been hesitant to outwardly call for some major push in migrants coming here because of the debate over immigration and the natural pushback they get from Republicans. But really, the kind of numbers we're talking about from Afghanistan at this point are in the thousands. It's not a very high number of thousands. We still don't have specifics on how many refugees, but in the context of the broader immigration debate in comparison to work visas for people coming across the U.S.-Mexico border, it's not a huge number. And this is more a political debate or just a debate about human rights rather than something that would make a really significant dent in immigration in the terms that we usually have it.
Hey, Jack, appreciate the hard work you're putting in at the moment. We really do. Thanks for getting up early and joining us. Jack Fitzpatrick there of Bloomberg Government. Anne-Marie's thinking, why didn't you thank me? I woke up an hour early. Thank you, Anne-Marie, for coming on with us as well.
Yeah.
You know, Anne-Marie, you know what she gets like, Tom? Get those emails from down in DC of complaining. Futures down 37 on the S&P, down 0.8%. Yields are in 3 basis points on a 10-year to 122.83. And Tom, copper, crude, take your pick in the commodity market.
Copper, LME down 3 standard deviations. John, I must admit that gets my attention.
Yep, copper down by 2.9%. From New York City for our audience worldwide. Bit of risk aversion this Thursday morning. Good morning to you all. We're down 36 on the S&P. We're negative 0.8%. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Heard on radio, seen on TV. This is Bloomberg Surveillance.
You can now fly into the UK from the United States. What about some reciprocity?
No, so the opening up by the UK government was terrific. We saw, in fact, the day that it was announced, we saw our daily new bookings triple between JFK and Heathrow. So that was great. And as a US-based carrier, honestly, most of what we're going to sell is going to be in the US. So that was great for JetBlue. The US government should open up. There is no reason not to. You know, you can fly from countries that have much higher COVID infection rates, but you can't come from countries in Europe where infection rates are much lower. That is not a risk-based approach. When it's going to open up, I couldn't tell you. It's something that we and the other airlines in the US continue a dialogue on with the administration.
By Christmas?
I mean, hopefully even sooner than that. But of course, I don't really know. It's really hard to predict how they're thinking about it.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City for our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance. Good morning. Here is the Thursday morning price action. We're negative 0.8% on the S&P. We're down 0.6 on the NASDAQ and off by about 1.61% on the Russell. Here's the cheat guide. Equities lower, as we start to fear the Fed taper. Headline. Here's the nuance. Switch up the board and get to what's happening in Europe. The FTSE 100 getting absolutely hammered right now, negative 2%. The CAC 40 over in Paris, France, negative 2.5%. And Tom, here are some movers for you, individual ones. Anglo, the miner, down 12 percentage points. Kering, the luxury goods maker, down by 7.5%. Here is the nuance, the detail. There is a massive China factor in this story. It's been weighing on commodities for quite a while in terms of the growth fears because of the additional restrictions. And then the additional story today in the mix overnight, Tom, a real conversation about wealth redistribution in China. Property taxes, those kinds of things, the rich giving back. And what does that mean for the luxury players? It means Kering, LVMH in Paris getting hammered. What does it mean for the miners, the growth fears? It means Anglo, Antofagasta with their own problems getting hammered. Tom, it's more than just the Federal Reserve and a very simplistic taper headline.
In China, I look at the monetary dynamics, John, and how they fold into their debt. We've seen headlines on the Bloomberg today on that. You've got to believe it's an eventful weekend. If I have to look, John, at one timeline, it would be Sunday evening New York time is when they make those announcements.
So let's get to those two things and combine them, Tom. Get to the bond market. Switch up the board. Look at 2s, 10s, and 30s. Your yield right now, 122.83. Your 30-year comes in 4 basis points to 185.81.
2%.
That curve is flatter, Tom. 2% is well north of where we are right now on 10s at 122.83. And my question of this morning, Tom, there's a lot more than just tapering going on here. But if it's tapering you worry about together with China growth fears as well, can those two things happen? Can you have the former if you have the latter? Do you really think the Federal Reserve starts to remove accommodation in a market where there's increasing fears about growth?
They're going to look at the jobs report on September 3rd, and they're particularly going to look at the inflation dynamic, which is wage growth or lack thereof.
I'm so with you, Tom, because I think September 3rd, that jobs report is far more important than anything that's about to happen over the next week in Jackson Hole, Wyoming.
Yeah, absolutely.
But what are our views worth?
No, Romaine's views are worth more than
worth far more.
Yeah.
That's why we had limited time with him. So let's get to him. 122.83 on 10s. With your movers, here's Romain Bostic. Hey, Romain.
Hey, good morning, John. Well, you did a good job of summing up the macro picture, and it is that macro picture that is driving a lot of the individual movers this morning. JP Morgan and the rest of the bank stocks are lower here in the pre-market. We should point out the regional banks are even doing worse. The KRX, the KBW Regional Bank Index, down now for 5 straight days as of yesterday's close. If it is down for a 6th straight day, that's going to be the longest daily losing streak going back to February. A lot of concern, not only about what folks are looking at there on the yield curve, but of course about the Delta variant and how that feeds into the broader economic picture. And of course, everyone still has their eye on what's going on over in China. Alibaba shares, 80 yards, I should say, down again here in the U.S., down the most, down to the lowest levels, I should say, going back to October of 2019. And we should point out that their Hong Kong shares, which of course just listed back in November of 2019, actually today hit a record low here. Keep an eye, of course, on Robinhood. This was a big story after the bell last night. First earnings as a publicly traded company. And really the big question now is if all of your money is being made off of something that's effectively a joke, does the company itself become a joke? You're talking about a company that doubled revenue in the most recent quarter, but more than 40% of that revenue basically came from the selling of cryptocurrencies, and more specifically, 60% of that came from Dogecoin itself. The company guiding a little bit. Yes, Tom, it was Dogecoin was the big driver of that revenue gain. It did not actually drive any profitability, and that's the big concern here, is that once that type of hype fades down, what's left here for the company? It's still a behemoth of a company, 25 million active users there on that platform there, and a company that still sees profitability in the future, but at least in the short term, some of those headwinds that they, tailwinds that they got from the meme stocks, that does appear to be fading. Flip of the board real quick, there still is a chip crisis out there. Toyota warning about that today, suspending production. A lot of companies here in the U.S. are lower, including General Motors and Ford. Remember, Toyota was actually managing the chip shortage probably better than any other automaker, so the fact that it's now warning on this issue raises a lot of questions about what GM and Ford are facing. And two bright spots real quickly: NVIDIA, a beat and raise quarter, and Macy's, a beat and raise quarter. And more importantly, Macy's now confident enough to actually reinstate its dividend, 15 cents a share per quarter, plus a $500 million buyback.
Romain Bostic, thank you so much. On this stew, we go macro. We do that with George Goncalves with MUFG Securities America's head of U.S. macro strategy. George, I want you to fold the GDP guesstimates into the dynamics of the market. You are acclaimed at yield dynamics. How do you fold a movable feast of GDP guesses into that?
you don't, Tom. I mean, and that's really the bottom line. We've been really divorced from these fundamentals for, going on 5-10 years, and this is something that I think most rate forecasters have been kind of struggling with, is trying to go back to what does growth and inflation really mean for what should be captured within an interest rate forecast, and I think that's the way things go. I mean, the bond market trades more and more on price and on momentum. It trades almost like a commodity in many regards, where yield becomes like a second thought until yields get too low, and then people start saying, wait, why am I buying it? There's not enough carry.
George, Lisa brought up a quote yesterday from Bank of America that I think is really important. I was talking about it as well. Bank of America suggested we were at the threshold of a major bifurcation of scenarios. They could see yields go to north of 2% by the end of the year, south of 1% by the end of the year. Do you think things are that finely balanced right now?
I mean, maybe not that finely balanced, but I do think that there is a break potentially coming up soon, and that is definitely true. And I think you kind of in your intro kind of alluded to these things that, on the one hand, the Fed is not going to get boxed in. I mean, we saw it from the RB and Z. If the Delta virus were to get worse, or if we get any sort of kind of slowdowns beyond what's being projected, or the concerns of like this kind of peak growth gets further entrenched, and that factors into a slower end of the year and into the early part of Q1, the Fed can just kind of always push back. That's what they'll always do. They're never going to pull forward tightening. They're always going to push it back. And of course, these global factors matter too. And so even if we were to handle the Delta virus better in the U.S., if the rest of the world either has more lockdowns, that's an issue. Plus this China growth dynamic, if that starts to really weigh on commodities and overall just kind of economic financial conditions, the Fed's going to take that into account as well.
When you say the Fed won't get boxed in other words, they don't want to necessarily commit to tapering, there is an issue of harmful effects of their carrying on with their programs the way they are for a longer period of time, especially as we do see inflationary pressures. Yes, they're idiosyncratic with respect to supply chain issues, but also on the margin, if we do get a rebound, like Goldman Sachs thinks, it could be that much bigger if the Fed keeps pumping money into the financial system. How much are you concerned that the Fed is shrugging off some of these deleterious effects of their continuing of monetary stimulus at this point?
Oh, I'm concerned. I mean, as we all know, it's not what we want the Fed to do or we think the Fed should do, it's what they will do, right? So we're always trying to forecast that. I mean, I do think that they should be in the process of tapering, and maybe they've overstayed their QE welcome from quarters now potentially, and they maybe we should have been starting sooner. But that's not my opinion, not necessarily what they're going to do.
Well, but let's go with that. Then what's the negative consequence of that you're willing to bet on, or that you're gaming out in terms of your market call?
Yeah, so right now, like the concern is, and we're seeing it manifest itself in the RRP, in the reverse repo program, and how there's too much liquidity. Even in the minutes yesterday, there was reference that potentially, as we head into a debt ceiling with all this liquidity, with the Fed not tapering yet, potentially, most likely, I don't think they're going to do it in September unless things really perfectly line up in terms of tapering announcement. And even if they do that, they're not going to start it in September. So there's going to be a lot of liquidity still in the system into this very acute period of excess liquidity. And so that causes an issue potentially for the money markets. So there's definitely signs that they need to be tapering and they need to get out of this QE business.
You've spent a long time with Japanese banks, George. The reason I bring that up is because you've got a lot of experience looking at the Japanese bond market. I want to understand from your perspective, because some people raise this question, and just because I'm asking it doesn't mean I believe it's going to happen. I think it's a question we need to be asking. Do you think we could replicate what we've seen take place in Japan over the last 20 years, which ultimately Europe took over in the last 10? Do you think that could happen in America?
So Europe is still struggling with believing that there's a Japanification going on within their bond market. But when you have negative rates and you have just low activity overall in Europe, I think Europe looks a lot more like Japan than the U.S. will, for the most part. But I think that we talk about always like these breaks in markets for the next quarter, but the real breaks is trying to understand the next 3 or 5 years if the U.S. can really get back into a growth trend that would prevent us from falling into like this Japan scenario.
George Concalves.
I would say no. I would say we're not there. It's not there yet.
I agree. MUFG, Securities and Macros Head of U.S. Macro Strategy. Lisa, we're not there yet. It's not clear yet, but that question's being asked continuously.
Especially if the Fed keeps on buying treasuries. And you talked about this week, the idea that the U.S. Treasury Department is going to sell less debt going forward. So if the Fed starts to taper, they'd only be keeping their stimulus the same pace. If they keep it the same pace it is now, it's actually increasing stimulus by some measures.
Increasing stimulus.
at this moment. Okay. Well, I mean, honestly, they're increasing their footprint in the market. I'm just struggling also with this idea of other consequences socially if they continue with this. In other words, people who are wealthy continue to increase their wealth, and the people who are not in the market are not participating in this.
Lisa, preach. How many people come on and talk about that? The asset issue right now. If you own assets, fantastic. They've gone up markedly. If you don't, you're suffering. That's the argument that the central banks are contributing to wealth inequality, Tom. Now, for the Federal Reserve to do something about it, they have to realize they're a part of it. Do you think they do?
Yeah, I think they do. I think the wealth inequality issue is from a tradition of lifting up all boats behind clearly the haves doing better versus a whole nother discussion wrapped around Gini coefficients and the rest of it. John, it's going to be addressed at Jackson Hole. It's addressed in the market every day. But you know what? The basic theory is what people are going to worry about. And my answer is, what's the theory right now?
We'll address
I'm not
it
sure.
with Dan Alpert in just a moment, Tom, at the top of the hour. 19 minutes away. Westwood Capital founding managing partner.
Perfect.
Looking forward to that. We're down 31. We're negative 0.7% on the S&P 500. Yields come in 3 basis points on 10s to 122.67. Let's call it 122.83. A defensive posture this Thursday morning from New York City. This is Bloomberg.
With the First Word News, I'm Laura Wright. The International Monetary Fund said that the new government in Afghanistan is cut off from using fund reserve assets. That comes just days before the nation was set to receive $500 million, and it deprives the Taliban of key resources. The IMF says Afghanistan can't use the money because the new regime lacks international recognition. In Haiti, the death toll from that earthquake last weekend has risen to almost 2,200. Meanwhile, tensions have been rising over the slow pace of aid reaching victims. They've complained of inadequate food and material needed to temporarily repair damaged homes. There are more than 10,000 firefighters battling wildfires in California, but that isn't enough, and the state is having a hard time fighting more wildfires as they rage across the western US and Canada. 12 major wildfires are now burning in California. The rout in Chinese tech giants got worse today after the industry was hit with a new round of proposed regulations. Alibaba fell to a record low in Hong Kong. Tencent and Meituan were also lower. China is studying proposals to further ensure the rights of drivers who work for online companies. The government may also step up oversight of the use of the live streaming industry. Shares of Toyota fell today. The worsening chip shortage will force the world's #1 automaker to cut global production next month by 40%. Toyota had intended to build 900,000 vehicles in September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we, developed world, need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
What were the numbers from the equities division? How well did it do?
Well, first 28% decrease as compared to a very, very good Q2 in 2020 is a good resilience. And it's a decrease that is much smaller than the one we have seen with some competitors.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Going to be very difficult for the Fed because they want to project certainty, or they want to project calm, that we've got this figured out, where inflation is going to go. It's going to be transitory. The fact of the matter is they don't know, we don't know. Inflation is a very difficult thing to get your head around, and it's a very difficult thing to understand.
Always brilliant to catch up with Jim Bianco of Bianco Research, the president. Good to see him yesterday from New York City this morning. Good morning, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Here's the state of play this morning. Waking up to a softer market, negative 0.7% on the S&P, with yields lower 3 basis points to 122.83, with crude down for a 6th straight session to $63.31. And the why? There are many whys. This from Andrew Brenner of Nat Alliance, going on to say plunging global sentiment from the Delta variant, fears of efficacy from vaccines, GS cutting their third quarter GDP, the realization that the Fed is tapering, and more Chinese anti-capitalistic regulations, the Red Sox collapse. All of that stuff, Tom. Put it all together.
Put it all together.
That's what you got on the screen today.
John, it's a drawdown. Let's go to the math.
Major.
This you do, folks, on the WEIF screen. David Wilson showed me that years ago, I say. SPX drawdown, negative 1.86%. On radio and television, the always handsome David Wilson. What do you got?
Well, it's kind of a corollary to what I talked about a couple of days ago. Back then, I looked at the Russell 1000 growth and value indexes and pointed out they basically have converged in terms of this year's performance, right? But then you do the same analysis with the Russell 2000 index, smaller companies, and you see there's no convergence at all. I mean, you're talking about quite the gap between the two. So you could argue it's sort of a great divide that we're seeing between these indexes. And, you know, there are a few reasons for it. One is that when you look at the Russell 2000 Growth Index, you see that healthcare is the biggest component. It also happens to be the only component of the Russell 2000 Growth Index that is down for the year. And, turn to technology, you see it's about half of the Russell 1000 growth index, and it's actually beating that benchmark this year. On the other hand, Russell 2000 tech is about 20%, and it's trailing.
So in your reading of the zeitgeist right now, what is the distinction, the interesting thing you see in the growth versus value debate? What makes you lean forward?
Well, it really comes down to, when you look at the Russell 2000, you got to ask yourself, is the gain that we're seeing in growth this year really just a matter of those big tech companies, the ones we always talk about, the Apples, the Microsofts, the Amazon.coms of the world.
It was just 12 stocks, whatever the number is, and everything else, right?
Well, it's kind of looking like that when you look at the growth part of the equation. Value, you can argue there's sort of a broader move going on, but, to see that kind of come around, I mean, it does kind of get your attention.
Lisa, save us. I have to remeasure the drawdown.
The drawdown curtains, find out some good ones. I will say that what you're talking about, Dave, is really highlighted by what Charles Rutsky of Mizuho wrote this morning. The S&P 500 is now down just 1.77%, but the average stock is off by 9.4%. And basically, when you take a look under the surface, you can see that save for those big tech stocks, you're seeing much more pain and broader based. And I'm wondering what the conclusion is that you're hearing from people about what that means going forward.
Well, I mean, there's some concern about whether it's finally time to have a pullback here. Bear in mind, you have to go back to October to see the last time the S&P 500 had a 5% drawdown from a high. There's been this persistent strength. 49 records for the index this year. I mean, that's the concern is, because you've kind of seen, smaller companies, riskier companies kind of tail off to some extent, arguably going back to February. Well, I mean, that's, why there's just this concern about how sustainable the gains are that we're seeing here.
But Dave, we have seen a drawdown in specific stocks. And I think that's the point, the idea that we have not gotten a drawdown that's significant in the index level, but that is because of these big tech names. We are seeing it under the surface. Does that mean we may not see the broad-based drawdown? However, people view this already as that and are starting to go in and buy a dip that did happen just in specific stocks.
Right. I mean, there is certainly that potential here. I mean, people are seeing the signs of weakness. They're pointing to, a variety of indicators that, suggest that what we're seeing, say, in the S&P 500 isn't the whole story. And yeah, you can argue that, to some extent there has been, sort of the buying of the dips on a broad level, even though you really haven't seen much of anything come out of the S&P 500 on that score.
David, I'm punching up here, and folks, you can do this on the Bloomberg. Try it at home. You can punch up like 1998.
Yes.
You want to talk about a drawdown? I mean, what we saw, I'm doing it right now, folks, in real time. Come on, the drawdown right now of 1.86% is back to August 3rd. Distant, far back.
Right. It's not much. There's no question. But we haven't seen much, for 10 months running. So, you talk 1998. Of course, you had the collapse of long-term capital management. You had the Russian debt default. I mean, you had some issues that the market definitely had to get through back then. And, there are issues today, but they're not, delivering the kind of severity that you saw in the 90s.
Yeah, David Wilson, thank you so much. John, the drawdown from July to September, make it late August 1998, was 19.36%.
I love it when we're just having conversations with each other, but doing it with other people, Tom. Why do I feel like the last 5 minutes was just you trolling me? When I say drawdown, Tom, I'm not talking about a big move. I'm just talking about direction. Just direction. Just coming in a little bit. Does that help? We're down a little bit this morning, 0.9%.
It is. I mean, the drawdown's there, John, and we're going to see. I don't mean to make light of it. There's so much going on now, John. And again, I would bring it over almost a shock, as you mentioned, China earlier.
China is the issue right now, Lisa, particularly for Europe, and we're seeing Europe get hit pretty hard. hit pretty hard over in France as well.
Yeah, there have been drawdowns. That was my point, is actually that you're not wrong saying that when you look at specific sectors. I'm looking, for example, at energy stocks. They're down nearly 13% since the end of June. I mean, you are seeing specific sectors totally get hammered, and this is because of what we're seeing in China. It's being buoyed by the revenue drivers in the United States, big tech.
Look at these headlines, one after one. This from Andrew Brenner of NAT Alliance. I read them off about 5 minutes ago. I'll do it again. This is what's going on right now. It's just more than one thing. Plunging global sentiment from the Delta variant, fears of efficacy from vaccines, Goldman Sachs cutting their third-quarter GDP estimates, realization the Fed is tapering, and more Chinese anti-capitalistic regulations. And we are talking about wealth redistribution in China as well. The luxury players front and center, Lisa.
Yeah, and this honestly is affecting and really throwing a crimp in the prospects for a lot of specific companies. I mean, if you're looking at the index level, it is being stabilized by these ballasts of cash flow. I mean, that is what we are seeing. And under the surface, there still is a lot of pain being priced in, which is fascinating given the sanguine nature of some of these price moves.
The equity market down 38 on the S&P. We're negative 0.9%. Alongside Tom Keene and Elisa Abramowitz, I'm Jonathan Ferro. Your bond market, it looks defensive, doesn't it? Yields lower by 3 basis points to 122.50. Euro dollar negative 1/10% to about 117. And crude, a whole lot softer. This is 6 days of this now on crude. We're negative again by 3.65%. On WTI, $63 and about 7 cents. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance, and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There's an unprecedented amount of liquidity everywhere. A lot of it seems to be kind of on the sidelines.
The biggest driver, I think, of growth slowing is the fear of restrictions from the Delta variant.
The consumer is still seeing a strong economy. They just are a little bit less excited to participate in it.
It's likely we return back to the growth levels that we saw at the end of 2019, early 2020. So prior to the pandemic.
Rates peaked in April, and that gives me confidence that the markets already anticipated this slowdown.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A bear market, well, it's a simulcast on Bloomberg Radio and Bloomberg Television. John, we retest the lows of an hour and a half ago right now. Futures at -41, Dow futures -363.
The S&P 500 down 0.9%. The bond market bid yields lower in crude. Tom, we've had 6 days of it. Crude lower, negative. WTI 63.24. It's tapering. It's China. It's the Delta variant. It's take your pick. It's all coming together over the last couple of days.
What's your
Tom.
insight off the Bloomberg terminal right now, John?
Equities, Tom, lower in Europe. I want to talk about Europe a little bit more than I want to talk about the United States. China's talking about wealth redistribution. That's really hitting the luxury players over in Paris, France. The CAC 40 is down by 2% and more. And my point there, Tom, is there is so much more going on than just the taper story at the Federal Reserve. There's a whole lot more going on, more specifically in China.
Well, in China, it's there, and it's been there. John, you've been great on this as we see some real GDP issues. Lisa Abramowitz, I'm going to give you a major shout out. Not only the Toyota news today, and that stock down off supply, off supply issues. But Lisa, as we go to Dan Alpert in a moment, the supply dynamics now are really front and center.
The idea here that when you get the inventories that are being depleted by the high demand of goods, and you're getting it so that companies, corporations cannot import more because it is not there to be had. People are not able to get the ships over to other countries. This is causing inflationary pressures. This is causing consumer sentiment to take a hit lower. And then you also have this question of how quickly will we get this back online at a time when companies are really short of goods to sell.
John, bounce it, John, from Toyota back over to China. Ningbo, the shipping port there constrained. You know the shipping costs right now out of China, and that folds into China is the global thermometer here.
And Tom, it comes back, though, to the market bias. Delayed, not derailed. It is recovery delayed, not recovery derailed. And Neil Dutter of Renaissance Macro will join us in about 27 minutes' time, and he'll talk about that. The Goldman forecast, the absolute beating that Q3 forecast got, Tom, but it's followed up with a Q4 upgrade because many people believe anything you take away from Q3, you get back in Q4. That's the conversation we need to have about this economy. I
have trouble with a quarter-to-quarter parlor game, particularly given the Delta variant. John, we really have to say, away from the shock of Afghanistan, Delta variant is the new regressor in this equation.
And COVID elimination as a strategy, Tom, makes you so sensitive to one case, New Zealand, a handful of cases, China. And that's where the weakness is coming from at the moment. And to Lisa's point, both on the demand side, Tom, and on the supply side as well.
Swiss franc in, euro under a 117. A weaker euro finally gives way to a 116 handle. John mentioned oil. John, I'm just going to mention the VIX, 24.40. What do you see?
Euro, 116 handle. Dollar strength. Dollar index with a 93 handle. Tom, euro dollar 116.97, down a little more than 1/10 of 1%. And equities, there's your pullback. your drawdown. We're down by 0.9%. I'm winding you up. We're down 1% on the S&P. We're negative, Tom, about 42 points.
Maybe there, but it is a deceleration. And again, for those of you looking at this morning, we welcome all of you on radio and TV. And the S&P futures now giving way. We're not through the low, which was seen off the surveillance cursor at about 5:16 a.m. Daniel Alpert is not worried about 5:16 a.m. He has a longer view, and it is codified in his classic, The Age of Oversupply. It was one of the 2 or 3 prescient books of the financial crisis. The supply disruptions are tangible. Mr. Alpert joins us this morning. Daniel, in the middle of your book, you talk about bad policy, denial, and decline. Are you that gloomy now? Do we have denial and decline operating in 2021?
No, I think we actually have been fairly reactive to the facts on the ground, and our policy is actually rather progressive relative to where we were back then. But just look at where we are from the standpoint of the Fed's tapering. Contrast what you're seeing right now to what you were seeing in 2013. You have equities selling off. You have a bunch of media headlines that say that the equities are worried about tapering. And yet the bond market is demonstrating something completely different than what it did in 2013. It's rallying. And more importantly, you've got, exactly what I think John was talking about just before. You've got things going on in China and Europe that are really setting a tone for the equity markets apart from any concern about tapering.
Yeah.
So this is a very, very different situation. Domestically, policy is actually moving in the right direction.
The optimist, Dan Alpert, and I'm going to lead here with a superb interview with David Stubbs of JP Morgan yesterday, I believe it was, and Ben Laidler's Morning Note. These guys say we're in a technological revolution. Can that overcome the gloom of this or the gloom of that?
Well, technology, unfortunately, tends to pass itself through to real productivity through the manufacturing process and goods producing process. We've sort of deluded ourselves for a couple of decades thinking that these lovely devices we keep in our pockets and all of this prospects of AI in the future are going to provide some enormous productivity boost. They did during the internet revolution. We saw a huge jump in productivity, but that leveled out, starting in 2003. And since then, we haven't seen that boost simply because this country doesn't really produce a lot in terms of goods. So a lot of the improvements that we've seen in terms of productivity have migrated abroad. The ability of technology to be a real game changer really depends on finding avenues and channels for that technology to really add to domestic productivity. And some of the policy that we're talking about, especially in green energy, actually has the prospect of doing that.
Well, in the meantime, Dan, as you were saying, we don't really produce that many goods relative to the economic impulse of services in the United States. And this strikes me when John talks about whether we have a recovery delayed or derailed. I mean, if you have services still not back up to pre-pandemic levels at a time when goods purchases are ramping up dramatically way above that, I'm just wondering whether we can have simply a delayed recovery versus scarring that goes far deeper than people previously expected by the prolonged pandemic.
Now, I'm gonna introduce just a slightly different take in that, are we actually experiencing a cyclical recovery? All my business cyclical focused colleagues are looking at this because there was a brief recession as a restart in a business cycle. I view the pandemic as something that is completely sui generis. It's something apart from a conventional cycle. We shut down the economy, we put it into a medically induced coma, and what we're doing right now is coming out of a huge amount of disruptions across the board, labor disruptions, supply chain disruptions, everything. But the question is, and I don't think this has been answered yet, is whether or not this is a real early stage cyclical recovery or just an extension of a long in the tooth recovery that extends all the way back to 2012 with the middle stages of the recovery from the Great Recession. So I don't think that book's been written yet. I think it's going to be very interesting to see. Clearly, we've got some major disruptions, though, that are coming out of the pandemic aspects of this, putting aside Delta variant, which is certainly a big issue. I'm not minimizing that. But we've got a big act that's coming to a close on September 6th. We've got 12 million people still in the labor force who are still receiving federally supplemented unemployment benefits. And those people are going to be back in the labor force at some point. It may take a month or two to show up, but that is going to be a major game changer going into Q4. So any estimates of what's going to happen at the end of the year, I think, need to be tempered by understanding that that's something that we've never really experienced before. That sort of major drop-off in support, that's the last of the major pandemic supports.
Dan, it's such a good final point. We needed to hear from you this morning, and I'm pleased we did. Dan Alpert there of Westwood Capital. Thank you, sir. We mentioned what's happening in Europe just briefly. Let's look at the luxury players just quickly. Hermes, Kering, LVMH. Kering's down more than 8%. LVMH is down by 5.6%. We've talked a little bit this morning about this high-level party meeting that took place in China, led by President Xi, who has called on high-income groups to give back to society more. It's weighing on the luxury players. Tom, here are the stats. A lot of reaction from the sell side. This was from UBS. Swatch has an estimated 50% exposure to Chinese consumers pre-COVID. Burberry around 40%. Richemont around 40%. Hermes around 35%. Prada, approximately 35%, Kering, 33%, LVMH, 31%. Those numbers coming out of UBS this morning. Tom, that just gives you an idea of what is happening here in Europe this morning, with a CAC 40 down by almost 3%, and those luxury players getting absolutely hammered because of this conversation in the world's second largest economy.
I completely take the point of the tourism issue and of the luxury China issue, John. I've actually sat, John, I know you're not going to believe this, I've sat in the Gucci store Florence.
I'm shocked.
And there were not one, but two good people from China, each holding 3 cell phones, one showing the photo of whatever they were looking at, one on the phone talking, and I don't even know what the third phone was doing. And the answer is there weren't one, there were 2 of them in the Gucci store. And so I walked out without making a purchase.
And Lisa, that's not happening because the travel isn't happening in the same way, point one. And that may not happen in the future, point 2, because there might be this push for wealth redistribution over in China.
Yeah, flaunting your wealth is going out of favor in a lot of places throughout the world.
It's going to be very interesting to see what happens there. Your equity market down 36. On the S&P, we are negative 0.8%. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden will keep U.S. troops in Afghanistan until all Americans are able to leave the country. That's even if it takes longer than his August 31st deadline to withdraw. The president also told ABC News that he doesn't think the withdrawal could have been handled better. Plus, he said the intelligence community did not predict the Taliban would take over Afghanistan so quickly. A new study says that coronavirus vaccines are less effective against the Delta variant of the disease. That could lead to a push for booster shots for fully vaccinated people. The British study said that the Pfizer and BioNTech's vaccine lost effectiveness in the first 90 days after full vaccination. In China, regulators had a tough warning for the struggling Evergrande Group. They told the conglomerate to resolve its debt problems and stop spreading untrue information. It was a rare public rebuke of the developer. Evergrande has more than $300 billion in liabilities. Its fate has broader implications for the financial system and millions of homeowners. Amazon reportedly will expand into an area where it has been traditionally a disruptor, bricks and mortar retail. According to Dow Jones, Amazon plans to open several large physical retail stores in the U.S. They're designed to extend the company's reach in clothing, household items, electronics, and other products. Macy's is out with a sales forecast for the fiscal year that beats estimates. The department store chain also reinstated its quarterly dividend and authorized a $500 million stock buyback. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
is Venezuela, a country that has suffered one of the greatest economic and humanitarian crises in modern history. Today, it appears Nicolas Maduro and his government are prepared to negotiate an agreement that might end U.S. sanctions and pave the way for free and fair elections.
Hopefully, we can find paths of closeness, of respect.
Join Bloomberg Television for a special report, Inside Venezuela, Friday at 7.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How are you navigating what seems to be a really tough situation better than almost anyone else?
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance as well as, guide up for the rest of the year.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
The chip shortage is also, which is driven by the capacity. Already the actions has been taken by our suppliers, and this will also go away. Whether this will go away in short term, I don't think so. Whether it will continue in long term, I don't think so, but it will continue in midterm.
They are the questions. That was Ashwani Gupta, the Nissan COO from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. It's a risk-off Thursday morning, that's for sure. We're negative 0.8% on the S&P. Your bond market's firmer, as it should be. On a morning like this morning, yields are down 2 basis points on a 10-year. In the FX market, we've been this way the last couple of hours. Euro-dollar slightly negative, down a little more than a tenth at 116.97. And crude down for a sixth straight session. We are negative 3.39% on WTI. Tom Keene, 63.24.
I'm going to call it a wait to the tape. Anyone looking for a recovery from 4 or 5 a.m. this morning, we don't see it at this time. Right now in China, the many Chinas, the many stories from China. We're thrilled Enda Curran could join from Hong Kong, our chief Asia economics correspondent. And there's a lot of things to talk about here. Let me go as quickly as I can. Elizabeth Economy, my book of the summer a number of summers ago, The Third Revolution. That's about President Xi. His revolution looks the same as every other revolution, which is a $21.6 billion bailout of a given company. Is it business as usual where the government will save the day?
Well, it does seem that way, actually, Tom, because there had been a lot of uncertainty, like you mentioned, about one of the big bad banks here, Horong. There was a feeling that perhaps there could be a restructuring or even a default. Well, the state has stepped in now. They will be recapitalizing
forwrong to the tune of about 7.7 billion. In fact, our colleagues out of Beijing are reporting, and that's a big signal that China is there still, that there's still such a thing as too big to fail. And then tonight, of course, we had news that Evergrande, this big property company that has liabilities of about 50 billion, that was called in for Stern talking to. So clearly they're going to get it going over next.
Well, they might step in some players, but not in others. And I'm saying this in a day when Alibaba is hitting a new low in Hong Kong. You're seeing Tencent sell off as they warn of further regulatory pressures. At what point do we look at a changed China that is emphasizing something more social and much less economic?
Well, common prosperity was the theme of this week, Lisa. I mean, to your point, in terms of the tech stocks, today the triggers were specifically, like you mentioned, Tencent warning there's more regulation coming, and there was also this proposal that China is looking at about making sure drivers who work for online companies get looked after better. And this fits into this idea that came out this week called common prosperity. And President Xi is basically pushing for a redistribution of wealth. This goes well beyond just reining in tech billionaires. So the tech stocks might take the headlines, but this is something of a wider fundamental reshaping of the economy that's going on. And it's all about boosting population growth, creating a more productive workforce, and of course, getting China to be world leader in so many things from manufacturing to technology. So, yeah, I would go beyond the moves in tech stocks, and I would dig deeper into what common prosperity will actually mean.
So, Ender, I'd go beyond maybe the luxury players as well. The luxury goods makers are taking a hit off the back of this. Most people attributing the move over in Europe right now to the conversation we're having. The biggest risk at the moment for investors, and it's been something that's lingered for a long time, Ender, and you know better than me, the risk of a property tax. A big property tax going through in China. Ender, can you walk us through that? What that would look like and what that could possibly do to growth more broadly?
Well, look, property, I think, accounts for property in total as a multiplier accounts for maybe a quarter of activity in China. Jonathan, it's a huge part of it. There has been discussion around property taxes. There's even been discussion about higher taxes in general. But I think right here, right now, the authorities might be relaxed by the fact that property prices have come off their peak recently. They're cooling a little bit, according to recent data. The authorities in Xi'an have been making clear property are for living in, not for speculation. So the fact that the steam out come out of house prices might just take some of the steam out of that debate over a property tax as well. As you say, of course, the economy is at a pretty fragile juncture right now. It hasn't quite pulled clear of COVID. It looked like it had for much of the past year, but it's had its scare. So I think the feeling among analysts is that tax is on the table. There are discussions going on, but maybe now it's not the right time to push that through.
And Curran, it's good to catch up. As always, it's good to hear from you. Our Bloomberg Chief Asia Economics Correspondent. 70% of household wealth tied to properties, the team at Bloomberg writing, Tom. In China, 70% of household wealth is tied to properties. If you want to do something about wealth distribution, that, without a doubt, is going to be a focus. I have no idea what they're going to do. Ender, I think, is far better placed than I to go through that. I know he is, but it's up there, Tom.
It's always been there. BNP Paribas was path-breaking on this, and a major shout-out to what UBS did with the wonderful Jonathan Anderson years ago on this. John, it's the same. My basic theme with Liz economy there is I'm not sure anything's changed in China, John.
Well, so much growth comes from property investment. And Lisa, I think that's probably the broader macro risk story here. You've got the optics on the one side. If you have an administration, the Chinese Communist Party, starting to make some noise about wealth redistribution, you don't want to be going out buying and loading up with Louis Vuitton bags, do you? You don't want to be walking around doing that kind of shopping. That's optics. Let's talk substance. The broader macro risk is that they do something on tax.
Well, and here's the question. How much tolerance do they have in the economic fallout in order to reach more socially equitable rules? And this, to me, has been the big surprise and the big sea change this year. You know, the idea that Alibaba and Tencent, two tech companies that were the pride of this country, are falling, and that the government does not seem to care to step in. In fact, they're going to double down on some of these regulatory pressures that are keeping stocks going even lower, indicates a complete shift in psychology. The emphasis has changed, and how far they are willing to go will determine the win and the loss of a lot of different sectors in the economy there in China.
Well said, Lisa. Tom, I mentioned it a little bit earlier on the program that pretty much every single slowdown, growth scare for the last 5 years and maybe longer has been born in China, and you wonder to what extent the growth scare, if we can call it that, right now. I think that's up for debate still, whether the growth scare right now, to what extent that can be blamed on what's happening in the world's second largest economy as well.
For the media on a Thursday morning, it's called a growth scare because that gets people going. But John, your point is correct, is what's the durability of a growth scare? The optimists are going to talk about growthiness, technological innovation, and an ability to get beyond with microeconomics, the supply constraint, and get beyond a natural disaster, as Dan Elpert mentioned, a medical disaster of this pandemic.
Well, let's tee up the brilliant Neil Dutter of Renaissance Macro. Tom, in about 6 minutes time, we'll get initial jobless claims in America, then we'll catch up with Neil. Neil's on point and has been throughout the whole of this recovery. There is a belief that goes way beyond the work of Renaissance Macro. It's widely shared that if you take anything away from Q3, you get it back in Q4 and beyond, Tom.
Well,
that's the belief. That's the consensus view.
Some of it you get back, but what I really see is the underpinning of Dutta's optimism, and he's been brilliant on that, and others as well, is technology to the fore. And I don't see technology off the rails right now, John.
Neil has been fantastic, and he joins us next. Here's the price action going into that jobless claims print in America. Equity futures are down about 31, with negative 0.7% on the S&P 500. A couple of days of losses on the S&P. I believe we've had 5 straight days of losses now on the airlines.
I'm looking for an entry point.
And on energy equities as well. And it's that breakdown in the cyclical story that predates the Fed minutes from yesterday. We can build on that a little bit more a little bit later. Bond yields in 2 basis points to 123.33 on 10s. Crude lower by 3 percentage points to 63.44. And euro dollar basically unchanged from where it was an hour ago. We're down 0.1% to 116.97. On radio, on TV, jobless claims next. This is Bloomberg.
is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Power of Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report. The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
We're live from New York City for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Your equity market is negative, down 33 on the S&P. We are negative 0.7%, off by 0.75% on the S&P 500. Waiting for some economic data in America. With that data in just a moment, here's Michael McKee. Good morning, Mike.
Good morning, John. Well, here we go with the jobless claims numbers that everybody's been keeping an eye out for, and it's pretty good news. 348,000 jobless claims. That's down from 375 the prior week. The continuing claims number, 2,820,000. We'll get that right. The number in the headline is a decrease of 29,000 from the previous week. It's the lowest revised level, the lowest level since March 14th, 2020, when it was 256,000. So we are getting back to normal in the jobless claims data. Getting there slowly but surely. The prior week was revised up to 377 from 375, so not a big deal. And the one number that I keep following and a lot of people are looking at in terms of what the long-term impact is the ongoing claims, the total number of people who are getting claims paid right now, and that drops by 311,000 to 11,743,000 in the week ending July 31st. So overall number of people who are getting jobless claims is falling. We're going to see the people who are getting the pandemic emergency claims, the gig workers, fall off. And so that plays into the whole Fed question about tapering is what's the impact of that going to be when those excess numbers, when those excess benefits start to fall off. The other number out this morning, the Philadelphia Fed business outlook comes in at 19.4. That's down from 21.9. So a little bit of slowing there. Taking a look at the important numbers that we care about. The prices paid index, though, goes up 71.2 versus 69.7. The employment index is at 32.6 versus 29.2. So more people going to get hired in the Philadelphia area, but they're going to be paying more for their supplies.
It's the right kind of downside surprise on claims. Let's whip through the price action just briefly. No real change off the back of this. We're down by 0.75% on the S&P. Futures softer, lower, negative, Tom, by 33 on the S&P. And 43 cents.
Again, 30-year bond, 1.87%, gets my attention, well under 2%. And John and I are watching stronger dollar, 93.35 on DXY. He is optimistic. His name is Neil Dutta, and he has courageously carved an optimistic tone on the classic GDP formula. He joins us now on a day of a multiple set of glooms. Neil, within the GDP formula, what's going to come to the rescue? Is it the consumer? Is it investment, net exports? What comes to the rescue to give us a better than good outcome?
Well, I think it's inventories. When you look at the last ISM number, the customer inventories index, that looks at respondents that are saying their current level of inventories are too low compared to too high. And it's basically at a record. So basically manufacturing survey respondents are telling you their inventory levels are too low. Basically what that means is they're going to be, working to fill those inventories, right? They need to get inventories into line with final demand. And while inventories, over long periods of time kind of net out to zero, they do in the short run contribute a lot to cyclical swings in growth. And that's going to put manufacturing production into overdrive. So, when you look at things like Philly Fed at 19.4, that's still a pretty healthy number. And so, manufacturing production is going to be a tailwind for economic activity. And as those inventories catch up to final demand, that's going to be a big tailwind for overall GDP growth.
I just took Philadelphia Fed folks off my terminal here back 15 years, and Neil's right, it's nicely above the long-term moving average. Neil Dutta, what is your GDP for 2021? We're seeing everybody market and market down. Where are you for the economic growth of the nation for this calendar year?
Yeah, I think like 6.5%, 7% is not beyond the realm of expectations. I understand that people are taking their forecast down for the third quarter. I think that's largely just a mechanical adjustment to what's going on with the Delta variant. So you have increasing COVID spread. People are taking matters into their own hands and staying away from restaurants, air travel, hotels, these sort of high-touch services. But You know, I mean, the people that I talk to have a time horizon that extends beyond 3 weeks. And, you know, when I look further out, the 12 to 18 month outlook, can anyone really say that that's materially changed? If anything, you're seeing more activity getting pushed into that time frame.
Neil, this is such an important point. If you'll allow me to jump in. Sure. We've been talking about your point through this morning. For you and others, it's recovery delayed, not derailed. That any growth we lose in this quarter, we regain in the next quarter, in the year after that. Neil, what's the difference between a recovery that's delayed and a recovery that's derailed? What distinguishes the two things?
Well, I'm just saying there's not as much structural, you know, changes in consumer behavior than people are expecting right now. So just extrapolating what's going on in August isn't necessarily going to tell you much about what's going to happen next August. It may well be, John, that we're trading a bit more COVID risk now for a lot less COVID risk later. Certainly, if you look at you know, some of the data on coronavirus, it looks like cases will probably start to peak sometime in the next week, and case growth will begin to moderate. To the extent that COVID is an issue, I think it's more of an issue in the Asia-Pacific economies, right? Australia, New Zealand, certainly Vietnam, you know, you're seeing, and so maybe that's going to exacerbate some supply chain issues, but at the end of the day, I don't think it's going to matter much for the U.S. housing situation.
Well, but Neil, there does seem to be a 1-2 punch here. On one hand,
here we go.
I mean, no, I'm just throwing this out
Lisa,
there.
Lisa, aren't you tired of being wrong for the last 12
Being
months?
skeptical. I'm not making a market call. Honestly, it's honestly trying to come up to look around corners. Wow, you come out with gloves on. Bear with me while I try to ask my question. But like just this 1-2 punch of supply chain disruptions that are causing higher input costs, in addition to a Fed that's being that much more patient because of some of the headwinds that the economy is experiencing. I mean, does this contribute to higher inflation on the margins down the line than otherwise would happen?
Well, I think it's not so much about the inflation, in my view. It's about what the Fed is going to do about it, right? I mean, so I concede that point. I mean, you have had a little bit of, you could say, stagflation light concerns coming to the market. Growth has weakened. I mean, even the Fed staff took down their growth outlook and revised up their inflation outlook. You saw it on the minutes yesterday. But again, I think that's probably going to be temporary. And certainly, you know, you have seen things like used car prices come down. I mean, if anything, in the July data, the supply chain issues are becoming less prevalent, right? I mean, if you look at housing units under construction, still going up, completions going up. So even as starts moderated, right? So that tells you that builders are working through those backlogs. And similarly, we had a nice pop in manufacturing production, driven by autos, motor vehicles.
Neil, can I ask you a question? Why does it make you upset to hear people try to come up with potential bearish counterpoints at a time when there still is a lot of pain in the economy? I mean, yes, it has been a particularly optimistic view.
My job, Lisa, is to take an economics call and help investors turn that into some kind of a market call. In other words, help them make money. So if I wanted to be bearish, I would tell people to pile. I mean, at the end of the day, it's not about what GDP is. It's irrelevant. It's using that and translating it into a market call. So if you want to go head first and buy utilities hand over fist, be my guest. But I'll be telling people to do something else. And that's ultimately how business economics, market economics, that's why it's important. A GDP call on its own is irrelevant. What matters is taking that GDP call and translating it into some kind of market outlook. So, you know, if I'm looking at it and I'm telling, and people are saying you want to be raising cash for the last 12 months, I mean, it's ridiculous. So I think the cyclical trade is probably taking a temporary break, but this is essentially, in my view, a consolidation within an ongoing uptrend in the market.
You two should have your own show. Tom and I could just sit it out. Tom and I could just take a break. Neil Dutton, Neil, it's good to catch up. We appreciate your time. Renaissance Macro Research Head of US Economic Research. Sounded a bit testy, but I know we're all friends here. And Lisa, you do have to interrogate the bullish view just to find out what people really think. And Neil's been right over the last 12 months.
Absolutely.
He's been right to be constructive.
And kudos to him. I think that it's important, though, to have skepticism because, honestly, that is our job as journalists, as people who are questioning the common thought.
I would take this right to Jackson Hole, John. It's going to be fascinating to see
Are
the
you going to give your
emphasis-
plane ticket to Neil now?
No, yeah, the
He's like, no.
emphasis or
Absolutely
de-emphasis,
not.
seriously, the emphasis or de-emphasis on social economic policy. Mr. Dudd is saying he really doesn't care about it. What he cares about is economics and data, it's a boom economy. We all understand
Yeah,
that.
but I'd go one step further as well. And Lisa will agree with this because Lisa and I have had this conversation a million times. When you're in the market and you've got to offer a view on where the economy's going, you get far more attention with these outlier calls that we're going into a bear market, growth's going to be terrible, huge downside surprise. But when you're an economist, you've got to make projections and ultimately make projections for people who want to make money. The calls that have made money are the more constructive ones. And Lisa, I think you'd agree with me on this. The more constructive view seems to attract more negative attention in the press, even though the more constructive view...
I strongly agree with that.
It's often turned out to be right.
Part of the issue is the disparity between the market view and problems in the economy that people are looking at and seeing and feeling, and they're trying to reconcile the two. And increasingly, and I think this is a really important point, the S&P 500 is less representative of the overall economy, especially with the dominance of the big tech giants. So you do have to wonder how to reconcile these two. That market call can absolutely be correct while also dealing with certain economic issues that you have to bring light to.
With every scare, though, you've made money being optimistic.
It's true.
Tom, without a doubt, bottom line.
Absolutely.
Yeah, to me, is it the need or desire of monetary authorities to craft social policy? That's going to be a debate at Jackson Hole.
I can't believe I'm leaving now, and you haven't even had a dig at me for taking a long vacation. Goodbye. Coming up on the Open, Laura Kane of UBS Global Wealth Management.
You're not in tomorrow?
My final show of the year. I'll be gone for a while from New York City.
For the year?
For our audience worldwide. I'm writing a book.
What is this, a sabbatical?
What, Capri?
Something like that. This is Bloomberg Surveillance.
Really?
With the First Word News, I'm Laura Wright. The International Monetary Fund said that the new government in Afghanistan is cut off from using fund reserve assets. That comes just days before the nation was set to receive $500 million, and it deprives the Taliban of key resources. The IMF says Afghanistan can't use the money because the new regime lacks international recognition. In Haiti, the death toll from that earthquake last weekend has risen to almost 2,200. Meanwhile, tensions have been rising over the slow pace of aid reaching victims. They've complained of inadequate food and material needed to temporarily repair damaged homes. Shares of Robinhood are down sharply in pre-market trading. The brokerage warned that the crypto-driven surge it saw in second quarter revenue may not last. Revenue from cryptocurrency trading was up 4,500% from a year earlier. That underscores the ever-shifting preferences of retail traders. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
They have been looking at outside of New York for offices. How are you thinking about your footprint as people return to the office and want to work from different places?
Yeah, so it's the new Apollo. You know, I think flexibility is the name of the game. When it comes for us in our business, I think that we really preach the mantra of flexibility. I think we've proven throughout COVID that we can be highly effective. In fact, if you look at the bottom line, I think more effective than we've ever been in our history through a flexible work environment. So as we head back to the fall, we've really preached to all of our businesses to lean in and embrace this flexibility and go where the market goes. You know, we're in a competitive industry. Our portfolio companies are in a very competitive labor environment. And I think businesses that just want to go back to the way things were are missing a huge opportunity to learn from what's gone on over the last 18 months.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Amazon reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
They didn't tell you that they wanted troops to stay?
No, not in terms of whether we were going to get out in a time frame, all troops. They didn't argue against that.
So no one told, your military advisors did not tell you, no, we should just keep 2,500 troops. It's been a stable situation for the last several years. We can do that. We can continue to do that.
No, no one said that to me that I can recall.
The President of the United States with ABC and Mr. Stephanopoulos this morning making headlines worldwide. We continue our discussion here on Bloomberg Surveillance. We're convinced that experts matter. Thomas Barfield of Boston University with us the other day. Admiral Stavridis will join us in the 9 o'clock hour. And now we are honored to bring you someone who has lived and thought more about terror, well, than anyone I can imagine. Fawaz Gerges joins us with London School of Economics. Professor, thank you so much for joining us today. I want to know what the Taliban is going to do in Herat, what they're going to do up to the north, what they're going to do in Kandahar and down to the Pakistani border. What do you predict the Taliban will do in the coming months and years?
Well, if you ask me what is the strategic priority for the Taliban, I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically engaging in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed. And that's why my take on it, I don't think we're going to see any major terrorist groups establishing a base of operation in Afghanistan, at least in the near future.
Professor, is there a risk of a Sunni-Shia civil war? If the Taliban are considered Pashtun and with a Sunni background, is there a risk of the two Islamic states fracturing this new Islamic emirate?
First of all, in the late 1990s, what we know about the Taliban, Taliban is one of the most extremist base Sunni groups in the world in terms of ideology. And we know in the late 1990s, they basically murdered many Shiites because the Taliban are a Sunni group. But again, if you listen carefully to what the Taliban have done in the past few months, they have engaged their bitter enemies. They have been talking to the Iran. Iran is a Shia-based state. In fact, just 2 days ago, when the Shiites were celebrating their basically religious annual ritual, they made it very clear that they will protect the Shiites. So no, I don't see any kind of a major rift between the Sunnis and the Shiites in Afghanistan. What I see is that the Taliban would like to change the world's view of the Taliban. They want to rebrand themselves. They want to convince the world that they are not as extremist as they used to be in the 1990s. They want international recognition and legitimacy. And this shows how clever, how strategic they have been in the past year or so.
Professor Gerges, there is a question, though, of how far they will take this stage that they're trying to get on internationally when it comes to any potential alliance with al-Qaeda or trying to root out potential terrorist groups that have traditionally used Afghanistan's soil to prepare attacks. How much are they going to push back or try to eliminate that type of threat as they try to gain international prowess?
Well, I mean, you're asking a very critical question. We think of the Taliban as a monolith. The Taliban is not a monolith, even though it acted militarily as a strategic disciplined movement in the past few months. You have some factions within the Taliban that have had some good relations with al-Qaeda, in particular the Haqqani network. But again, my take on it is that at this particular stage, al-Qaeda has become a liability for the Taliban. In fact, al-Qaeda has become a liability for everyone, including the Pakistanis. Why? The Taliban is a shadow of its former self. It has weakened greatly. It's leaderless. And also we need to think about, we keep talking about Afghanistan on 9/11. Transnational jihadism has mutated. I mean, think about it now. Where are the groups that support al-Qaeda and the Islamic States? They're not in Afghanistan. They're in Iraq, in Syria, in Africa, in Sahel, in the Sinai Peninsula, not in Afghanistan or even not in Pakistan.
We have to leave it there, Professor. We've just run out of time. We look forward again to speak to you. Fawaz Gerges with us, with the London School of Economics, professor of Middle East politics and international relations. Lisa, I just think this is so important. We're going to drive forward the conversation with Stavridis in the 9 o'clock hour.
Well, President Biden even coming out this morning and saying that there is increased chances of a terrorist threat coming out of Afghanistan. And you do wonder how much capability a disjointed Taliban has to try to make good on some of their pledges in order to root out other fringe terrorist organizations. And this really is an ongoing threat, in addition to all of the other geopolitical concerns that we've been talking about over the past week.
Lisa, do you agree with me that the great distinction here is it's this Taliban, too, if you will, amid social media? The communication apparatus of any nation, any city, any set of tribes like Afghanistan is different than the last time around.
Yeah, one of the first interviews that the new leadership, the Talibani leadership gave was with a female television host in terms of trying to message a different Taliban. However, the practices on the ground from reports seem to be a little bit different. I mean, this really has been a major story socially. For the markets, however, everyone's shrugging it off, it seems like, unless there's a fiscal kind of blowback with respect to Biden's agenda.
A little bit of a bid to the markets right now. We had a 24 handle on VIX, now 23.77. I don't want to oversell that right now. Futures, negative 36. Dow futures at negative 330 as well. And the yield coming in 1.24%. It'll be an interesting open. You need to stay with us on television, on radio at 12 noon. the Congresswoman from Michigan with great perspective, Debbie Dingell, will join. Stay with us. This is Bloomberg.
I'm Erin Coscarelli with an exclusive Western and Southern Open update for Bloomberg TV and radio from Tennis Channel. Former world number one Naomi Osaka made her return to the WTA Tour on day 3 in Cincinnati. The reigning U.S. Open champion fought back from a set and a break down to get past team phenom Coco Gauff and reached the 3rd round. The 4-time major winner is playing in her first tournament since withdrawing from the French Open, citing mental health issues.
I've had a really weird year. I think maybe some of you guys know what happened to me this year, but I feel like I changed my mindset a lot. I think even if I lost, I would have felt like I was a winner. There's so much stuff going on in the world.
And don't forget, Tennis Channel's exclusive live coverage hits the air daily at 11 a.m. Eastern. I'm Erin Coscarelli.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Equities lower this morning from New York City. Good morning, good morning. 30 minutes away from the opening bell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, the Fed's next move.
Tapering.
The Fed's tapering announcement.
It is expected.
Tapering may be starting this year rather than next.
We've heard all about the deliberations, the evolving views on it.
We're going to get some sort of taper announcement this year.
They still need to soften their language.
It could be that at Jackson Hole we get much closer.
We have some influential speakers saying that they expect tapering.
They are vocal and they are starting to get their way.
Markets have been well prepared.
And the problem is that if you give the markets an inch by starting to taper, then they take a yard and start fretting about imminent rate hikes.
Almost playing a chess game between the Fed, central banks and market participants.
Very difficult to separate the idea of tapering from tightening.
What the minutes are telling us is that tapering will happen at some point.
Nobody's going to be surprised to see if tapering starts at the end of this year.
Joining us now to discuss is Invesco's Rob Waldner, Laura Kane of UBS Wealth Management, and BlackRock's Michael Fredericks. Guys, great to catch up with all of you. Equity futures down 0.8%. Laura Kane, straight to you. If in doubt, blame the Fed. Is it a little bit more complicated than that?
Yeah, so I would say that in terms of the volatility that we're seeing, there are certainly fears about the potential for tapering to start this year. But our base case is that we will see the Fed announce the start of the taper in December of this year, but won't actually start scaling back asset purchases until January of next year. And the reason for that is that we're still seeing that this pandemic is sticking with us. We're not past it yet. If you look at since the last Fed meeting at the end of July, we've actually seen the 7-day moving average of COVID cases double during that time period. So we think that the Fed will hold back until we see the virus cases at least come back down to that end of July level. So even though that, I think it's these combined factors. So it's the thoughts of tapering combined with the fears around the virus that are really causing the volatility in the market.
Laura, there's so much going on here, and I think you've given us a list there. And Rob Waldner, I'm sure much of that list resonates with you. Your take, please, sir.
Yeah, John, after looking at the minutes from yesterday, I think it's pretty clear that the Fed will be tapering this year. I actually think because if in the minutes, most of the Fed members think they've met their inflation criteria, with core PCE running something around 3.5%. They feel like they've made up for the shortfall in past years. That's at least what the minutes say. And with more than 10 million open positions out there, I think there's no doubt we're going to make substantial further progress on the labor market issues. Put a lot more people to work. Unemployment's only at 5.4%. And that will drop quite quickly. So I think the Fed, in the framework they've set up, they really have put themselves in a position where I think we will hear about tapering from Jackson Hole, some talk about it. And I wouldn't be surprised if we get tapering starting in November, let's say, of this year.
Well, that's your call, Rob. Others share it too. Right now, we're negative 34. We're down 0.8%. Michael, what strikes me as pretty interesting, isn't there a contradiction at play here? Can you be worried about growth and also be worried about tapering? Does the latter happen if you're worried about the former?
Well, look, I think the Fed has been very communicative. I think the market is repriced substantially. The market is now pricing in Fed liftoff in late 2022. So there should be no surprise. And I think your opening set of clips is kind of testament to that everyone's focused on this. No one should be surprised that the Fed is going to start to taper. And I think there have been a little bit of growth wobbles, whether it's China-related over the last couple of days, or University of Michigan confidence was certainly surprisingly weak last Friday. So, I think there are reasons to be a little bit concerned or see a little bit of a pullback, but we're still pretty positive on risk assets. So there's still a lot to like. Earnings growth has been terrific. But the bigger point in my mind is that I think a lot of the easy money has been made and valuations are pretty rich. And going forward, it's going to get a little bit tougher because, economic growth momentum is rolling over and we're going to move closer to, Fed tapering, Fed liftoff. And I think we should expect to see more volatility and bigger pullbacks than we've seen over the last few months, which have been really shallow.
We'll get into them in just a moment, Michael. Just a range of views on the taper timeline. Here's one more from Bank of America's Mark Cabana, good friend of this program and this network over the years. He says the following: we changed our base case for taper to start in November 21 versus a previous call of January 22 after the meeting adjustments. Let's bring in Mike McKee for a little bit more on this. Morning, Mike.
Good morning, John. Well, the meeting's minutes did suggest that the Fed is going to taper. I was going to look for some sort of way to put this fancy, like, John, you know, it's Wednesday yesterday, today is Thursday, but you knew that. We knew the Fed was going to taper. The only question kind of now is when, and we got some more answers from the Fed. Right now, they're saying most participants judge the committee's standard of substantial further progress toward the maximum employment goal had not yet been met, but at the same time, most participants remarked this standard had been achieved with respect to the price stability goal. In other words, we can go forward. And so most participants, they said, judged it could be appropriate to start reducing the pace of asset purchases this year. Now, that all depends on how the economy evolves, and there is high uncertainty, the Fed said, and you can see the reasons there: Delta variant, supply chain disruptions, elevated asset prices. They even brought up stablecoins as a potential threat or a potential problem. The other part of the discussion, how to taper and how fast. Many of them said, taper fast enough to finish before we get to the rate move. And that gets to what Ian Shepherdson was talking about in your introduction there. Can the public separate rate moves from tapering? The second idea is start sooner, taper more slowly. And most of them said taper proportionately. We're going to do mortgages and treasuries at the same amount of time. So what's next? You can see the calendar there. August 27th, Jay Powell in Jackson Hole, and we get PCE inflation the same day. The August jobs report on September 3rd. September 22nd, the FOMC meets next, and that's when we could get an announcement. And then the question is, when do they actually start? A lot of people on bond desks this morning, John, saying that's sort of like angels dancing on the head of a pin. Whether they start in November or they start in January, does it really matter to the market if they just cut by 10 billion when they start doing that?
Mike, I'm with you, totally. You and I are on the same page, and from conversations we have online and offline, you know that. Mike McKee, thank you, sir. Goldman cut its growth outlook in the past 24 hours. They didn't talk about the Fed. They didn't talk about tapering. They downgraded Q3. They upgraded Q4 to a degree. And this is what's interesting for me. They just cited the Delta variant. That's what they cited here. Here's the quote: the impact of the Delta variant on growth, inflation, proving to be somewhat larger than we expected. I want to go back to you, Laura Kane, on this. Goldman are downgrading Q3. They're upgrading Q4. They're not having a conversation about tapering. They are talking about the Delta variant. And what's interesting for me, for them and for others, it is growth delayed, recovery delayed, but not derailed. Is that your view too?
Yes, I would agree with that. So it does seem like it's more growth delayed rather than derailed. So we think that we will get past this Delta wave. If we look at other countries that suffered from this wave of the Delta virus before us, we did see that they were successful in bending the curve. So we think that we will get there. We believe that vaccines are effective against severe illness, and we think that we will see this reopening and recovery get back on track. And then looking forward, we do feel that economic growth is going to be strong, and it's going to be supported not just by a strong consumer, but also by strong business spending. So we expect to see a strong and long CapEx cycle. Inventories are way below normal right now, so we expect to see businesses investing in new capacity, investing in improving their businesses coming out of the pandemic. And we could also see infrastructure be another catalyst. So we are expecting to see strong growth going forward. So even though we may have hit the peak, it's important to keep in mind that growth will still be strong and above historical norms for at least this next 6 to 9 months. So we're still very optimistic.
And others are too. I caught up with a fired up Neil Dutter of Renaissance Macro earlier this morning. He said we may well be trading a bit more COVID risk in Q3 for a lot less COVID risk in Q4. A lot of people share this view, Michael. So help me understand from your perspective why maybe this doesn't quite fully resonate with you, given that you're expecting a little bit more of a pullback.
Yeah, but just to define that, I'm talking about over the next, say, 12 months. That's where I think in the shorter run, I think it's relatively smooth sailing, and we're actually looking to add to risk on this pullback. But I think if you look out into next year, that's where I think we've had a lot of positive tailwinds, a lot of really strong economic momentum, and as we come off the boil and normalize, that's where I think it becomes a little bit more challenging. We're still pretty positive, but I just think we need to expect a little more volatility than we've had, where we've had nothing but tailwinds. I think the headwinds and tailwinds start to merge a bit going out further. But no, I think it's perfectly logical, and we have a lot of regard for Jan's work at Goldman in terms of the Delta impact. And you are seeing evidence like in airfares and travel and some of the reopening parts of the economy take a little bit of a hit from Delta, but I don't think you should miss the big picture that there's still a lot of things to like when it comes to risk assets, especially equities.
Yeah, Michael, I'm pleased you brought up the cyclical hit that we've seen, because the energy players, the airline players, they've been down for 5 straight sessions on the S&P 500. I'm talking about airline equities, energy equities. We're down 5%, we're down 6% and more. Looking at this is Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, the cyclical is definitely falling out of favor, and you can actually see that in the cyclicals defensives pair index, which is basically an index that tracks a pair trade where you go long on the cyclicals and short on the defensives. And that has started to go the other way, actually on a downtrend really since June. Investors seem to be less willing to bet on some of those economically sensitive groups of stocks amid concerns around the Delta variant and the growth trajectory, and instead they are seeking safety. And as for how that is broken down on a sector basis, so far in August, the outperformance has come from the likes of utilities, healthcare, staples. Yes, financials are up there too, but overall a more defensive tone, while underperforming are the likes of industrials, materials, and energy. Energy down about 5.5% on the month thus far. And actually, since its peak in June, the energy index has fallen more than 16%, cutting its gains for the year in half. And of course, that has as we've seen oil fall from its peak around $75 in July to around $63 this morning, in part due to a stronger dollar, concerns around the Fed tapering, but also concerns around growth and demand, especially in China. And that has weighed in turn on the industrial metals. Copper down about 6.5% over the last few weeks, and iron ore has gotten absolutely crushed, John.
Absolutely amazing price action. Katie, thank you. Thank you so much. Michael, I just want to return to you because you said you'd buy into the weakness. We've seen a lot of weakness. It predates the Fed minutes. Let's be clear about that. We've seen it in the airlines, seen it in energy equities, both equities and credit. Where specifically would you lean into right now?
We like these think of quality as a theme or a factor. We think this part of the market makes a lot of sense, in part because when you look at the alternatives on the fixed income side, one of the questions we're getting all the time from clients right now is, what do I do with my core bond exposure? And I don't want to be in cash, and there are negative real yields out there everywhere you look, and so it's a pretty tough setup. And when I think about just how do you want to position, I think people are moving out the risk spectrum, and I don't think if you're leaving kind of core fixed income because of the really pretty limited upside when you think about all the duration risk and really tight spreads. I think people are migrating out into equities, but I don't think they're buying technology. I don't necessarily think they're drifting out into a deep value and those types of stocks. I think what they're focusing on is more on quality, high free cash flow generating companies, global kind of large cap stocks that pay relatively healthy dividends and dividend growth. That's where we've been adding. It's worked well, and that's where we're looking to continue to add.
It's a similar conversation in credit too. Rob Walder, just finally to you for this part of the program, that discrimination. I've been asking this question over the last few weeks. You're starting to see that a little bit more in credit.
Well, you are starting to see some discrimination in credit. I mean, it's very interesting to see. You've talked already today about what's going on in China. There's a lot of credit issues going on in China. We've seen overnight that the Chinese government is going to stand behind Huarong, but, Evergrande is on its own. So we're starting to see an awful lot of differentiation in credit. That I think is part of an environment where we've passed peak growth. We still have very favorable fundamentals. But the overall global growth momentum is slowing somewhat, and that's when you'll start to see more of this differentiation. But overall, the headline, the overall level of credit markets and equity market will continue to march higher, even with some of this movement under the surface.
Rob Waldner, Laura Kane, Michael Frederick sticking with us. Let's get some price action. Equities lower. Here are the movers. Here's Abby.
Well, John, on the prospect of the Fed tapering sooner rather than later, plus the slowing growth fears, stocks and commodities both lower. You put it together, materials and energy stocks tumbling in a big way. Metals and miners down. Of course, also China telling exporters to reduce shipments, iron down. So you can see Freeport-McMoRan and Cliffs Natural Resources responding. Energy no longer the top sector on the year, down 17% from its recent peak today. ExxonMobil and Schlumberger both sharply lower, so that sell-off in natural resources very clear. However, it's so risk-off that you don't even have bonds selling off, yields rising on the possibility of this sort of taper. Instead, yields in, that is weighing on banks, and there's nowhere to hide, John. Take a look at tech, not even tech responding well to yields in. A rough day for the markets.
Apple down 0.8%. Abby, thank you. Coming up next on the program, the divide between the United States and China, how one country is handling the COVID experience and how the other is doing something totally different. It's a shakeout driven by China. I want to talk about that next. From New York, this is Bloomberg.
We talk about those NPLs. Will they stay high?
As all of you are very fully aware that the second COVID wave hit India hard and hit India suddenly. So obviously, I would say almost 50 days of the quarter were impacted in a very significant manner. And that has come through on the retail portfolio side. So while all the banks and financial institutions saw higher than expected retail slippages during the quarter, but we do believe it is transitory. We expect moderation in the second half of the year. We've already seen positive trends come through in the second half of June, and July has been much better than June, and I think the same trend has continued in August also. The demand resolution, which was 98%, is already reached 99.5%, or what I would say pre-COVID levels. There is a 26% year-on-year recovery, improvement in recovery.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Vaccines are the best defense, but masks are extremely helpful as well. And for those who aren't eligible for the vaccine yet, children under the age of 12, masks are the best available protection for them and the adults around them. That's why we need to make sure children are wearing masks in school.
President Biden beefing up the response to a surge in Delta variant infections. Wall Street following suit, with most major banks tightening office policies. Things have changed. Things have shifted in the last month. With more, here's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, the return to work policy is starting to be reworked, and that is true for Wells Fargo, which has pushed back its return to office date from September to October and is requiring any staff already in the office wear masks, which echoes the policies we see at the likes of JP Morgan, Bank of America, and even Goldman Sachs is considering. But some banks going even farther, Morgan Stanley requiring proof of vaccinations as of October 1st, and Citigroup also has told employees in several cities they need to be vaccinated prior to returning. And it's not just about offices, John. As President Biden was saying, schools are dealing with the this too as summer comes to an end. And just overnight, 2 districts in Florida instituting mask mandates in defiance of Governor DeSantis, as thousands of students in the state have had to isolate or quarantine due to exposure. And more broadly, cases are climbing in the younger population, children making up 18% of U.S. cases last week. And of course, those under 12 don't even have the option to be vaccinated at this point. Finally, John, a note on what the rise in case count means from an economic perspective. We have seen consumer sentiment falling as the COVID case curve arcs upward. That was evidenced by that UMich data last week, the lowest reading since 2011. And of course, that Goldman Sachs call you were referring to earlier, cutting its growth outlook because consumers may end up spending a lot less, John.
Kelly, thank you. That's the situation in America. Let's talk about the situation elsewhere. There is a COVID elimination strategy in places like China, in New Zealand. New Zealand supposedly was meant to hike interest rates earlier this week. It was one case, a 3-day lockdown, no interest rate hike, and that currency's been getting slammed. The Aussie this morning as well. I want to bring in Rob Waldner, Laura Kane, Michael Frederickson, get straight into this story. Michael, there's a very different strategy in places like China. Is that behind or part of the reason why you've downgraded the international outlook, EM, China, etc., and maybe looked a little bit more at the United States?
That's a big part of it, John. There's a combination of Delta as well as some policy shifts from China, where we all know the story. There's been tangible changes from a regulatory standpoint and from a focus of regulators, and that has us more cautious on emerging markets in particular, where we've been cutting back. Outside of China, I have to say, most emerging markets from an equities perspective have done pretty well year to date, but China is such a big part of the EM index that it's a bit hard to avoid. So, I think that is part of the story, and you've seen some pretty weak credit growth, and you've seen some of the challenges that were flagged earlier with China property sector. So on the one hand, we look at China and we say, the spreads are really pretty punchy, and the yields in a yield-starved world look pretty attractive, but there's a lot of opaqueness with respect to some of the things that are happening under the hood, particularly in the property sector.
It's getting so difficult to understand. And I think if you're waking up this morning and you're looking at Europe, and Europe's down, and it's down really hard, look at the movers. Over in Paris, France, Kering's down by 8%. LVMH is down by 5%. Laura Kane, it's not just a growth concern. There's a conversation about wealth redistribution over in China. And overnight, that has absolutely slammed some of these European equities. With that in mind, Laura, if it's really difficult to read the United States, it's even harder to read what's happening in China. How can you be long China, EM, Europe for that matter, that whole entire bucket, without having a decent read on what's going on in that economy and with policy?
Well, first of all, I would say diversification is key, especially in these scenarios where we have more rapid or radical policy shifts. So we have become less optimistic on China. We do think that the regulatory crackdown in the tech sector is a concern, and it's something that could stay with us for some time. Longer term, we do think that there are a lot of interesting innovations taking place in China, whether it's in the fintech space or e-commerce space. But right now, we have become more cautious. So we are diversifying our exposure. One market where we are most preferred is actually in Japan. That's a country that's really struggled with the COVID cases. More recently, its stock price performance has lagged other markets, and we see a really interesting valuation opportunity there. So we are looking across the globe to see where different countries are with recovery from the virus, and how that's reflected or not within current valuation.
Laura, we'll keep this conversation going. Laura Kane, Rob Walden, Michael Frederick sticking with us. Up next, the morning calls, and later, more caution across the markets with investors looking to defensive stocks. More on that still ahead. From New York, this is Bloomberg. 5 minutes away from the opening bell in New York City this Thursday morning. Good morning. We declined by 0.6% on the S&P, on the Russell down 0.9, on the Nasdaq off by 0.5%. It's a move off the lows, a gradual one. That's the price action here in the morning calls. Roku getting its price target cut on Citi to 410, but maintaining a buy rating on the stock. The analysts pointing to disappointing growth, but saying revenue remains robust. Credit Suisse raising its price target on Nvidia to 225 from 175, citing strong earnings and guidance heading into the next quarter. And JP Morgan raising its price target on Apple to 180. The analyst citing multiple catalysts in the back half of the year, including the launch of the next generation iPhone. From New York City, your opening bell's about 4 minutes away. Apologies for that technical issue. From New York, your opening bell's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
25 seconds away from the opening bell in New York City this Thursday morning. Good morning. We are building up to losses this morning. We're down by about 29 on the S&P. We're negative 0.6%. We are off the lows, but still negative on the Russell, down about 0.9%. Your opening bell ringing in New York. Switch up the board and get to the bond market. Your 10-year shaping up as follows. Yields lower by just a basis point or two. We're down to 124.33. Euro dollar 116.95, basically where it has been through the last couple of hours. And in the commodity market, down for a sixth straight session. WTI 63.33, negative 3 percentage points. That's the cross-asset price action at the market desk with your movers. Here's Abby.
John, well, for the risk-off tone that we're starting off here for stocks in the U.S., it's global in nature because we had big selling in Asia with most of those indexes down more than 1%, and the stock 600 right now down about 1.8%. A piece of it is the auto sector because earlier Toyota said that they're cutting production on the chip shortage, so you can see that ADR down 3.3%, but Tesla, GM, and Ford following the European auto sector down right now 2.6%, so a brutal part of the market action. But the bigger piece probably has to do with the natural resources because we see not just stocks tumbling, but also commodities. That is taking steel stocks down, with iron down after China said that exporters should cut their shipments. Plus the energy sector, again, mentioning earlier, this has been the top sector on the year for quite some time. Now it is not, down about 17% from its recent peak, taking lots of the big energy names down. Nowhere to hide again on this day, John.
Abby, thank you. About a minute, and what are we? About 15 seconds into the session. We are lower by 0.5% on the S&P, on the Nasdaq off by 0.5%. It's been the same old story, the same conversation through the week. Investors showing caution with a growing list of headwinds, fueling a defensive portfolio tilt.
Sort of a barbell approach.
Barbell strategy.
Really taking that barbell approach is the way I think is probably best to position.
You want to put some more risk aversion in the portfolio.
Staying, away from, the sort of the middle section of the economy.
You need to be prudent. You need to be cautious.
Some of these value and cyclical sectors that have outperformed and are now trading in excess of valuation multiples.
You want a barbell, right? Low volatility.
That barbell word I've heard repeatedly through the week. Energy, airline names, they've all taken a beating over the last 5 days. You can call it the last 6. Over the last week, we're down by 7.82% on the energy stocks. On the airline names, we're down almost 6%. For more, let's bring in Bloomberg's Katie Lyons. Hey, Kaylee.
Hey, John. Well, the likes of the airlines falling out of favor, and as for what is coming into favor, it is more of those safety areas. I have a chart that shows the airlines relative to packaged foods, which of course is seen as more defensive. People are always going to need their stacks. And on a relative basis, airlines are underperforming that packaged food index at the lowest level since we have seen since back in May. And it's not just about the cyclical versus defensive narrative either. Sentiment on equities more broadly seems to be turning. If you take a look at the latest AAII survey, of course, the bulls have been in charge for basically all of this year, but that has now flipped with more investors bearish than bullish for the first time since January. So there is a bit more caution around the equity story, John, and that is driving people into hedges really across other asset classes. We have seen a buying coming in to treasuries over the last week, the 10-year yield down about 11 basis points over that time. Well, a bid has come into gold, up 2% when it comes to futures in the last 5 days, and demand for the dollar has driven it to its strongest since November of last year. And even though the dollar is stronger, the yen has caught a safe haven bid of its own, and it is stronger against the U.S. dollar by about 0.5% over the last week, John.
Kelly Lyons, thank you very much. Back with us, Rob Waldner, Laura Kane, Michael Fredericks. Laura, let's talk about this. We had a conversation briefly about it in the last 30 minutes. It's an important one. All the things we're talking about, none of it is new. And what I'm trying to understand, does it reinforce a move we've already seen? Does it justify it? Or is it fuel for another leg in the move that's behind us? I'm thinking treasury yields lower, airline stocks not doing well, energy names not doing well. How would you frame it, Laura, for us, for this audience, for your clients?
So I think what we're seeing right now is a temporary step back. And I think a lot of it has to do with what we're seeing with the Delta virus cases and how that's translated through into some high frequency data like consumer sentiment. So I think all of that's just kind of feeding into this fear momentum that we're seeing, but we think that it's going to be short-lived. We think that ultimately we will get past this Delta wave. We think the recovery and reopening will get back on track, and we're sticking with a cyclical bent to our positioning. So to sum it up, we do think that these headwinds will be temporary, and we're not changing our positions to become more defensive or to kind of scale back and position for a downturn in the economy. We expect growth is still going to be strong. Even if we've hit the peak, it's still going to be strong going forward.
Laura, the question I asked of others this morning, including Neil Dutta, Renaissance Macro, we had this conversation too. We talked about Q4 being the payback for the growth we lose in Q3. It's great. The recovery is not going to be derailed. It's delayed. You and I have talked about this. How would you know if you're wrong, Laura? What would you look for? What would say, you know what? I'm not right about this. It's not right to own the cyclicals anymore.
So I think what we would look for is a material deterioration in things like consumer spending. We would look at guidance from companies. If we don't see that business spending pickup that we're anticipating, I think if virus cases really pick up and we see that the vaccines, are not working, and that perhaps we have even another new variant of this COVID-19 virus, I think all of those things would lead to a change in positioning. But based on the evidence that we have so far, we do think we'll be able to get past this latest surge in the virus cases and get back on track with the reopening.
Michael, what would your answer be to the same question?
I think Laura answered it pretty well. I think we just talked about some of the shift in sentiment, and investors are getting more bearish. I'll take that as a positive. You look at option skew. There's a huge demand for downside protection, and put skew is, is really, really elevated. So, in my mind, this all sets up a more bullish picture. You always get a little nervous when everyone's on the one side of a trade, and so to see a little more caution, I think it's a little bit reactive, really, to some of Laura's comments. We think that the Delta is starting to roll over a little bit. There's evidence of that in some of the hardest hit states. So, I think this is a time to be leaning into risk.
Yields higher, Rob Waldner. I wanted to spend a little bit of time with you on that. They're lower this morning by about a basis point to 125. You think they go higher? You think, one, the bonds mispriced the Fed's path, and two, you think yields can be higher and this curve can be steeper. Can you walk us through that, Rob?
Yeah, well, John, just like the conversation around the equity market, we think this is a kind of buy on dips, sell on rallies sort of market where we do have a kind of range environment. And, as I said earlier, we are likely to get the Fed to taper this year. We are about to, it's very likely in our estimation that we'll achieve this sort of Fed's targets around price and probably labor market by the middle of next year. So we'll start to see interest rates go up at the short end, and that should also allow bond yields to go much higher. So as you say, we're expecting bond yields to go higher from here. The yield curve will go steeper for now, and eventually when we start to price in, Fed rate hikes in 2022, start to get a little bit of flattening with the short end rising.
Well, Rob, that's what I wanted to talk about, why the move at the front end would lead to a steeper yield curve. If you think we're underpricing the path of the Fed funds rate, that would mean for this market, if they had to price that in quickly, I would say it's up for debate as to whether that leads to a steeper curve. Some people might say it leads to a flatter one.
Well, let's look at what's driving the curve right now, and it's real yields. And real yields are based on what the Fed is sort of setting the tenor for real yields by keeping real yields at the short end and very, very negative. So I think in this environment, you would have to see inflation expectations come down a lot to see that curve flatten, as you're suggesting might happen. If inflation expectations stay where they are and real yields go up, you would see a steepener.
Don't you think the more aggressive Fed stance, though, would take away inflation expectations, Rob? I don't have a view on this. I'm just sort of walking through and stress testing your view with you.
Yeah. But John. So the question I would say is if the Fed was more aggressive, but it seems very unlikely the Fed will be more aggressive. Inflation right now is running core PCE 3.5%. The labor market unemployment's at 5.4. We think there's 10 million job openings. That's not an aggressive Fed. The Fed is clearly going to continue to lag behind. So that's how we think about it.
Laura, do you need higher yields to make this cyclical trade work?
So our base case forecast is that we do see yields go higher. So we're expecting yields to trend toward that 1.75% to 2% range. And that is part of our thesis for cyclicals and also for value companies. So that is part of our thought process. And the reason behind it is that we think that current yields are completely out of sync with our economic outlook. So we think that as yields start to reflect what we're expecting for the economy, we think that should all be supportive for those more cyclical and value parts of the market. So yes, that is part of our thesis.
And Michael, just finally to you, you're looking for the same thing?
I do think, say, the 10-year is, the path is considerably higher. You look at what's priced, the market is pricing in a 10-year at the end of 2022 at about 1.6%. Yeah, that's not much of a move. I'll take the over on that, and that's why we have a lot of duration hedges in the portfolio.
Michael, good to catch up, to get your views. Send my best to the team. Michael Fredericks, Laura Kane, and Robert Waldner. In your market right now, about 10 minutes in, off the lows, we're down by 0.4% on the S&P, the Nasdaq negative 0.5%. The losses are so much bigger over in Europe. The FTSE 100 down by 1.5%. In Paris, France, the CAC 40 down by more than 2 full percentage points. With your movers on this side of the Atlantic at the market desk, here's Abby.
Off the lows indeed, John, but we have some weakness, real weakness for that Nasdaq 100 now down for a third day in a row, the worst 3 days in a month. And it's interesting because in NVIDIA in the pre-market, after putting up a big quarter, that chip maker shares now down about 1%. So tech really not getting a break, even with yields in. Typically yields in would help out technology because valuation would look more solid, but the risk off tone right now, investors are scared. NVIDIA down 1.4%, again, despite that strong quarter. Apple down 1%, Microsoft outperforming, Facebook down 1%, and the tech selling, it truly started in the Asian session. John, if we take a look at some of the tech ADRs, we are going to see Alibaba, JD.com, and Baidu down more than 3% each as Tencent warns of more China tech crackdown coming, saying that, and some investors, of course, saying that these China tech stocks are not investable, an odd form of going concern risk, but there you have it. One tech index, China tech index, John, down more than 50% from the peak. That selling continues.
Abby, thank you. Thank you very much. Let me just work through this with you in real time. I want to bring up a note from UBS that came out a little bit earlier this morning off the back of this conversation about China and this redistribution of wealth. And go to what is happening in Paris, France at the moment. Kering's down by more than 8%. LVMH is down by 5.5%. Hermes is down by 4.8%. Did things start to change? And if they did, what would it mean? UBS have broke down the numbers on what each and every individual luxury goods company, how dependent they are on the Chinese consumer. Take a listen to this. Swatch, an estimated 50% exposure to Chinese consumers pre-COVID. These are pre-COVID numbers. Burberry, around 40%. Richemont, around 40%. Hermes, around 35%. Prada, around 35%. Kering, around 33%. LVMH, around 31%. That Chinese policy story is so important for what happens with those luxury goods makers. And when you wake up early in the morning and you see Europe down and down hard, got to look at why. It's the miners. The miners are in trouble. They've got their own problems. It's the luxury goods players. It's the LVMHs. It's the Kerings of this world. And it's less to do with, say, the taper story here, stateside. As for the story stateside, a conversation we've had all through the week I want to have next. There's a huge foreign policy issue at play right now for this administration. Will it overwhelm the domestic goals here at home? We'll discuss that next. Down in Washington with our Washington correspondent, Anne-Marie Hordern. From New York, this is Bloomberg.
This is Venezuela, a country that has suffered one of the greatest economic and humanitarian crises in modern history. Today, it appears Nicolás Maduro and his government are prepared to negotiate an agreement that might end U.S. sanctions and pave the way for free and fair elections.
Hopefully, we can find paths of closeness, of respect.
Join Bloomberg Television for a special report, Inside Venezuela, Friday at 7.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The idea that somehow there's a way to have gotten out without chaos ensuing, I don't know how that happens.
The view of the President of the United States. Afghanistan's exiled president had this to say, blaming the Taliban's takeover on, quote, the failure of the government leadership and the political failure of international allies. Let's head down to Washington, D.C. now and catch up with our Washington correspondent, Anne-Marie Hordern. Morning, Anne-Marie.
Good morning, John. There's going to be a lot of finger pointing about what is going on in Afghanistan and this withdrawal that we saw, a chaotic one. The president, though, last night, speaking to George Stephanopoulos on ABC, was really doubling down on the decision to withdraw and also seemed quite frustrated with the continuous questions about the execution of that, saying that it could always have been chaotic. And that is decisively different than what he told the press here on July 8th. Now, just in about 20 minutes' time, Jonathan, at the top of the hour, the president will be joined by his national security team to discuss what is going on in Afghanistan.
We can spend a lot of time, Anne-Marie, going over what has happened over the past week. Just help me with the look forward from here in the near term. There's a big conversation about how quickly we can get Americans, how quickly we can get out the individuals that helped Americans out of Kabul. How quickly can we do that, and by when?
Well, we just don't know. There's no solid answer on that yet. The president did say yesterday that if there are Americans past that August 31st deadline, he will maintain troops there to make sure they're out. But that brings another question. What about the thousands of Afghans that have helped America in their two-decade war in Afghanistan? It's quite a fluid situation. Yesterday, we heard from the general of the Joint Chiefs, General Mark Milley, saying that the fact that they do have the airport secured, but we see reports on the ground that what is going on around Kabul is that there are security checkpoints to the airport. So yes, maybe the United States can physically get you out, but you have to get yourself safely to the airport. It's a very fluid situation, and we're going to have to give updates day by day.
Well, relying on you for the updates, as always, Anne-Marie, the conversation we've had in markets is whether these issues will somehow overwhelm domestic policy goals for this administration. We caught up with Ian Bremmer of Eurasia Group. Take a listen to what he had to say.
We had the events of January 6th. I mean, that was enormously problematic in terms of showing political dysfunctionality in the U.S. And you can still get movement on bipartisanship for infrastructure on the back of that. This is a smaller deal for the average senator or member of the House of Representatives in Kabul than what happened on January 6th for the Republic. But we're not through this yet.
Anne-Marie, speak to that for us, just for a moment, that we've dealt with chaos before and we can still get things done. Can we still get things done?
I think the administration certainly thinks so and hopes so. You do have the House coming back from recess starting next week to push forward those objectives, the bipartisan infrastructure agreement, potentially how they do this dual approach, as well as the reconciliation, that framework. But on the other hand, Jonathan, there is this darkening cloud. This was supposed to be a almost honeymoon August for the president, right? He just secured this bipartisan infrastructure agreement in the Senate. And now there's going to be hearings in Congress about the administration's approach on the evacuation of Afghanistan.
Anne-Marie, thank you. Looking forward to the updates through the morning, through the day on Bloomberg TV and on Bloomberg Radio. Your price action stateside about 20 minutes into the session. We declined by 1/3 of 1% on the S&P, on the Nasdaq down by 0.4 of 1%. Let's lift the lid, so to speak, on the index. Long morning, forgive me. Let's lift the lid on the index and get you some sector price action. Here's our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. You've got 8 of the 11 main industry groups in the S&P 500 lower in early trading. It's really the commodity producers leading the way down, whether you're talking about energy or materials. And in terms of what's higher, utilities, consumer staples, food, beverage, tobacco, and real estate. And all those groups have a certain amount of defensiveness to them, so it's clear that people are kind of running for cover a little bit in today's trading. trading. I want to focus in, though, on department store chains. Now, you won't find any in the S&P 500. You've got Kohl's and Nordstrom in the mid-cap 400. You've got Macy's in the small-cap 600. We heard from 2 of the 3 chains today, and the news is being really well received. Kohl's up 4.7%. Macy's up more than 10%. They not only came out with earnings and raised their forecast, but also said they're going to start paying a dividend again and buy back as much as $500 million of stock. So you put it all together, and a group that arguably is kind of, marked time for the last several months is really moving higher. So, that's one area of strength in a market that's showing some broader weakness here, John.
Dave, just quickly on the airlines that you and I have been talking about, on the energy players, we're down for 6 straight sessions on the S&P 500 airlines. We're down for 6 straight sessions for energy equities as well. What's your read on what's taking place at the moment, Dave?
Well, I mean, you can kind of take those things separately in a sense, but they both really kind of tie back into what's happening with the Delta variant and the concern of what it means for the economy. With the airlines, it's, the simple willingness of consumers to travel that's the issue. With energy, you just have to wonder what happens to oil prices going forward. Are you going to have the demand, especially out of China, which has kind of been front and center in terms of, concern about where oil prices are going here. So put it all together. I mean, COVID-19 kind of covers it, but there are some elements in each as well.
Hey, Dave, thank you. Appreciate it. Our stocks editor there, Dave Wilson. On one of the sectors you need to look at just at the end there, the airlines one and energy another. Airlines are down for a 6th straight session. We're off by more than 8 percentage points over those 6 days. And this 6th day is not complete. Coming up, the market events you need to be watching. That'll be next in our trading diary as we work our way towards the weekend and look ahead to next week in Jackson Hole, Wyoming. From New York City this morning, good morning. This is Bloomberg. Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
What were the numbers from the equities division? How well did it do?
Well, first 28% decrease as compared to a very, very good Q2 in 2020 is a good resilience, and it's a decrease that is much smaller than the one we have seen with some competitors.
25 minutes into the session here in New York City this morning. Good morning. The S&P 500 recovering quite nicely. We're down a little more than 0.1% on the S&P. Session is still young. Bottom of the pile, energy equities again. Some real pain there. Top of the pile, utilities, defensive as you might expect. And as you might expect, underperforming the Russell, the small caps off by 0.6%. The Nasdaq down by 51 points. We're negative there about 1/3%. 3-day losing streak on the S&P. Switch up the board and get to the bond market. State of play as follows. In the bond market, 2s, 10s and 30s. 10-year yields down by about a basis point to 124.33. Yields lower by a couple of basis points on a 30-year to 187.96. Curve just a little bit flatter. Your next stop, is Jackson Hole, Wyoming, with the Fed chair and that speech you're all expecting. Then after that, what will really set us up, I think, for September 22nd, the Fed meeting, is September 3rd. It's the payrolls report. That's the price action. Let's get to your trading diary. How to navigate the path ahead into the weekend. A fresh round of housing data coming out at the top of the hour. Plus, the Conference Board's index for the month of July. Dallas Fed President Robert Kaplan will be speaking on Friday, and industrial earnings wrapping up the week. And finally, all eyes on next week as the Fed heads to Jackson Hole for the annual symposium. That will really kick off next Thursday. That's your main event for next week from New York City. Thank you for choosing Bloomberg TV. Thank you for choosing us. This was the Countdown to the Open. This is Bloomberg.